I'm here in New York City on this Friday morning. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Brian Sozzi this morning. Let's get to the three things that you need to know today.
First up, tracking the Santa Claus rally. We are on day 3 of 7 for this key seasonal trend. Stock futures are falling today after a mixed day on Wall Street Thursday. Dow ended just barely in the green, while the S&P and Nasdaq fell just below the flat line. Stocks are still on track for weekly gains, with the Dow and S&P 500 up over 1% and the Nasdaq up more than 2%.
Plus, Bitcoin rising this morning looked to claw back some of its losses. The cryptocurrency has not traded above 100,000 in more than a week. Bitcoin hit a record high of over 108,000 earlier this month in December. It's up nearly 40% since President-elect Trump's victory in early November. Investors are optimistic over Trump's pro-crypto stance and his proposed appointments of pro-crypto leaders into regulatory positions. Trump has also backed the idea of a strategic Bitcoin reserve.
And Nvidia is seeing a big influx of retail investors in 2024. The AI darling is the most bought equity by retail investors, raking it $30 billion in total net inflows, according to new data from Vanda Research. This is the second calendar year that a single stock has attracted more net inflows than the SPY. That's the ETF that tracks the S&P 500. The SPY only attracted half of Nvidia's inflows for the year. Nvidia is followed by SPA, Tesla, the QQQ, and AMD. Tesla won this slot in 2023 with almost $20 billion more in inflows. The results showing the impact of the AI hype on the broader markets.
Futures are lower as investors question whether stocks can meaningfully extend the Santa Claus rally as the final full trading week of 2024 it comes to a close. All three major averages are currently on track to churn out gains since the Santa Claus rally window started on Tuesday. The S&P 500 up nearly 2%, the Dow up 1.1%, and the Nasdaq up over 2%. Let's get into some of the trends that we've been noticing during the Santa Claus rally so far, and starting, for me at least, with the moves in banks. You're seeing some of the largest by market cap outpacing the S&P 500 in the period of time that we've been tracking the Santa Claus rally. I've been keeping close tabs on JPM, been keeping close tabs on Bank of America and Citigroup as well here. And of course, there's a lot of the tailwinds that they're riding post-election here, thinking about the deregulation and what that could mean ultimately for deal-making environment as well. Beneficial for banks, beneficial for underwriting fees, and then more largely here, we'll see exactly what's the net effect of them suing and this kind of combined efforts to make sure that they're pushing back against some of the stress tests. We'll see how that nets out, but more broadly, I think there has been a tenor of financials really being one of the top picks among the sector plays for next year.
I was just thinking, I don't know why I wore this tie today.
Why did you? It's
I don't
Friday.
know what I'm doing. Like,
it's a holiday week.
Yeah, I don't know. I just sometimes it's too formal, but well said on the financials. I see you burn up the Yahoo Finance platform over in your desk. For me, one observation is this. Really, the leaders of the market this year, 2024, even I would argue the leaders from 2023, these stocks still doing well. Brad, Palantir up 2% at the start of the Santa Claus rally, outperforming the S&P 500. AMD up 5%, outperforming the S&P 500. And then, of course, AI darling Nvidia, like we mentioned at the top of the show, that stock's up close to 4% to kick off this Santa Claus rally period. So seeing some interesting trends there. A lot of winners that have been winning in the market this year. Investors are sticking with these names because they know the stories, they know what's happening, and they're afraid really to get out of some of these hot trades. All right, now for a deeper dive into the action on Wall Street this week and what we can expect heading into 2025 of Andrew Briggs. He's a director of portfolio management and a wealth manager at Stewart Partners Plaza Advisory Group. Good to see you here, Andrew. I mean, I'm sure you saw at the top of the show, investors sticking with the hot trades. Is that the right play?
Yeah, I think you have to right now from a safety perspective. There's still a lot of uncertainty out there as we go into 25. Obviously, with inflation picking back up, or I should say no longer disinflating. And then you throw in the new administration coming in 2025. There's just a lot of uncertainty as that's been echoed in the corporate calls as well this past earnings season. So I think until there's some more clarity, it's tough to kind of broaden out that portfolio too quickly and leave, if you will, those safe defensive names that you guys have been mentioning.
Is the clarity in the form of the economic outlook? Is it in the form of earnings growth estimates even? What is kind of the major measuring stick that investors should be using in order for that clarity to really play through to some of their portfolio picks?
Yeah, good question. I think it's more on the, I would say the former, the economic side of things, as far as, the labor market is throwing a lot of mixed signals out there. Not a lot of hiring, but not a lot of layoffs. So first and foremost, I think need to get an understanding of, exactly where that sits. And then obviously throw in, I keep mentioning the new administration's impact on that, whether it's from immigration, what is that going to look like for the labor market, which has a direct impact on the consumer in the markets. Earnings wise, I would say quickly, you are starting to see some manager sentiment deteriorate there. Again, it keeps going back to the administration and what is really going to occur over the next year or two. There are lofty earnings, as we all know, whether it's upwards of 12, 13, 14% plus earnings expectations. So as we hand the baton from kind of valuations carrying the market to what people are expecting to be earnings, it is a high bar. And, I think it's going to be a lot to ask to have the so-called same, 5 to 10 names carry that slack.
If one is concerned about that earnings growth slowdown next year, Andrew, what are some top defensive strategies they could put into place today?
Sure. So I think, even if you just take the AI theme from that standpoint, as we kind of get into potentially the second or third phase, we've already seen that kind of breakout in the utilities area, if you will. Those are no longer the kind of traditional boring utilities that many people have been accustomed to. Same thing with the material side and even the software side as well. What is this going to look like as over the next decade, some of these AI themes continue to morph into the next beneficiaries of there. So we think those are some smart plays. And then additionally, again, going back to the policy administration, what's coming up here is if we get some more clarity there, it would be interesting to see from a market cap standpoint, if some of the small and mid cap names could start to make sense if they get some more firm ground from a financial standing. So a little bit more clarity again on what are interest rates going to do, as those companies are obviously much more directly impacted by those rates.
Andrew, is it as simple as that? Is it as simple as technology being the new defensive captain of the ship, if you will?
Yeah, I think so. I think that is kind of the new normal, if you will, given that just looking at the fundamentals in the balance sheets and you name the metric, off the charts, obviously starting to moderate a little bit, but relatively speaking, there's not many other segments that come close to them. So not recommending anything such as adding or, continuing to be much overweight in those names, but it's certainly hard to argue not having that be the highest percentage of the portfolio, at least on the equity side from that standpoint. The other thing I would say is just the U.S. I would say is a little bit different than the globally. And I think we could take a lot from the recent viewpoint of the disinflation that's kind of happened globally, not just here in the U.S. But what's different is if you look at, so-called Europe, let's mention, that disinflation has been a little bit more traditional, whereas it's kind of impacted growth negatively, some of the labor negatively, whereas the U.S. not so much. So we do think there's some different secular themes, if you will, that are taking hold right now, that the U.S. has that maybe some other nations do not have, which is changing the math on that. And the last thing I would say is, I do think that different secular shift potentially warrants, interest rates not as effective or as impactful as we've been kind of grown to think they have been.
Andrew, we were just talking about at the top of the show, Nvidia essentially being the stock market poster child based on flows over the course of this year. We're going to hear from Jensen Huang, who's going to keynote the CES conference at the beginning of next year. What could he get on stage and say that adds even further lighter fluid to the broader AI trade?
Yeah, we typically don't get too into the weeds directly with the client, with the stock names with the clients, but obviously it's a hard area not to focus on at the moment. I think he's just going to hopefully probably continue to talk about how it's just the early stages of this, as I mentioned. So, basically whether you want to call that phase one or phase two, I think it's still the early innings, whereas the next stage is going to be, how does that even continue to get scaled more broadly speaking? What's that next layer to have more people interact with it relative to just being the tech or the hardware engineers or whatnot? How do you scale that to get to the next level of more usefulness, broadly speaking?
Certainly. Andrew, thanks so much for taking the time here with us this morning. Really appreciate it.
Thank you, guys.
Certainly. OpenAI confirming plans to restructure its operations in 2025. It's going to be separating its nonprofit and for-profit arms. Now, the company outlining details in a blog post today, planning to create a public benefit corporation to oversee commercial operations and removing some of its nonprofit restrictions. The nonprofit will have a significant ownership stake in the OpenAI business. The company says that the move will allow them to raise necessary capital, and the plan faces opposition from, dare I say, Elon Musk. Because
Shocker.
It has faced opposition from Musk, among other figures out there as well.
The way I read this, of course, is two things. One, there's the broader, I guess, civilization aspect here. Here's a for-profit company moving really fast on developing AI technology, maybe without the proper guardrails in place. Now, can they continue to put up guardrails at the same time they're trying to make a profit, Brad? But number two, just from a pure stock and investing standpoint, this has to be good for Microsoft, has to be good for Nvidia. These are early investors inside of OpenAI. Theoretically, this opens a door for them raising more capital. The company was last valued at $157 billion. Last capital raise in October, that's double the prior valuation. Also good, I would think, Brad, for the broader AI trade. This profit motive may now have OpenAI, whether for right or for wrong, innovating even faster, causing other companies to try to catch up to what they're doing, causing maybe even faster chip development, and suddenly now you have the next potential tailwind for the AI trade next year.
Yeah, and in terms of Musk and how vocal he's been on this, I mean, even dating back to the summer of this year, talking about if OpenAI was infused within Apple's operating system, what steps that he would take to try and ban Apple and OpenAI on Twitter, on X, I should say, his platform. All these things considered, I mean, it comes at the same time where he's ramping up his own investments in XAI. Yeah. So any type of competition that we continue to see come forward. And we should also mention that it's not like he doesn't have partners for XAI. It seems like there's even more of a relationship that's brewing and solidifying between him and Jensen Huang as well here, as we've seen some of the images emerge of both of them together. So yeah. I think there are still some considerable partnerships that are yet to be netted out, especially as the application side of artificial intelligence and generative AI starts to formulate a little bit more. Well, retail investors also flocked to Nvidia this year. It saw nearly $30 billion in inflows over the course of 2024. That is according to Vonda Research. Now, rounding out the top three were SPY, that's pegged to the S&P 500, and Tesla. And this just comes back to how Nvidia has made it into the dinner table conversation, the wealth management conversation, the basketball court conversation. Wherever you are, you've probably heard somebody mention the ticker symbol NVDA and when they got in, perhaps, as well.
Yeah, you're right. This Nvidia has become a mainstream company. After a year, many people, I would say, still didn't really know what the company does. I would argue a lot of investors still don't know what Nvidia does. It's a very complicated company moving at a speed not many of its competitors are moving at. Certainly, that includes the folks over at Intel. What also stood out to me with this Vonda data, really two things, Brad. Within the top 20, in terms of the retail investors, what they own, JP Morgan and AT&T. Now, we've highlighted AT&T here throughout the year, had a lot of conversations with CEO John Stankey. One of the hottest performers this year has been AT&T as it's turned itself around. JP Morgan, of course, continuing to do well. And this fun fact, too, I think really speaks to, this other fun fact, really speaks to the retail investing community still very, very engaged in these markets. $265 billion of net new inflows into U.S. markets by the self-directed retail investor this year. That is down about $25 billion less than the past 3-year average. But nonetheless, that's a healthy number. Yeah. A healthy number of retail investors engaged in this market, trying to prove their financial situations and lives, and maybe not necessarily concerned about some of the valuations on these names. Whether they get concerned next year, to be determined.
But this also, it really does talk about a major shift that we've seen in the mind of some retail investors. We've gone from meme stock and the momentum trade to, okay, now we're looking at companies with fundamentals, we're looking at a longer term time horizon, and not just trying to hop in on the trade, but be true investors for a longer term period of time. And that's why you get into some of the fund manager surveys, which, where's the most overcrowded trade right now?
Mag 7.
Long Mag 7.
Yep.
So that really just gives you a little bit more of the mindset of how the retail investor has shifted in this near term, and how that's kind of mirroring what we've seen from a lot of institutions over the course of 2020.
Shout out retail investors. Love you guys.
Love you. All right. We want to take a moment to remember two business leaders who have passed in recent days. Richard Parsons, one of the most prominent black leaders in corporate America, has died at the age of 76. Parsons is best known for helping companies navigate times of distress, including Time Warner after its botched merger with AOL, and Citigroup in the aftermath of the financial crisis in 2008. Lazard, the financial services company, confirmed Parsons' death as he was a longtime board member, saying in a statement, "Dick's storied career embodied the finest traditions of American business leadership." Parsons also served as interim CEO of the Los Angeles Clippers in 2014 after the NBA banned the former owner over racist remarks, and he later joined CBS as interim chairman following the ouster of Les Moonves over sexual harassment and assault allegations. Lazard writing, quote, "Dick was the leader to whom other leaders turned for advice and a steady, sure set of hands during their most consequential moments."
And Osamu Suzuki, who led Japan's Suzuki Motor for more than 4 decades, has died at the age of 94. The company says he died of malignant lymphoma on Christmas Day. Suzuki transformed the business and drove global expansion to become a leader in small vehicles and motorcycles, bringing more than $30 billion in revenue a year. His legacy includes alliances with GM, Volkswagen, and competitor Toyota. And one of his greatest cited achievements is using his expertise in small cars to create a big market share in India. Suzuki joined Suzuki Motor in 1958. The company was founded by his wife's grandfather. At the time of his death, he remained a senior advisor to the company.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk NFLX, Netflix, bringing in more than 24 million viewers for coverage of 2 Christmas Day NFL games. According to a statement from Netflix, the game between the Kansas City Chiefs and Pittsburgh Steelers that averaged 24.1 million viewers, while the game between the Baltimore Ravens and Houston Texans drew 24.3 million. And yeah, you guessed it, it peaked at more than 27 million during Beyonce's halftime performance. Just going to show
It feels right.
why people tuned in, at least for a portion of that one. But it's not all good news for Netflix. Season 2 of the popular show Squid Game off to a lackluster start with less than favorable reviews. That's sending shares of related South Korean companies lower, including Artists United, which is a movie distributor and marketing firm, which Squid Game's main character and their main actor is the largest shareholder, plus Dexter Studios, a Korean partner of Netflix. The third and final season of Squid Game expected next year.
Are you a Squid Games guy?
Haven't seen more than half an episode.
I watched like 2. I mean, this is some dark stuff. Apparently, I mean, the New York Times didn't really give it a glowing review. I mean, it's hard. Once you've had that type of success, it's hard to come up and follow up with a great sequel. I mean, that's just the case with movies and content.
It's the holidays. Nobody wants to be that upset all the time. Like, get some Cinnamon Toast Crunch or something like that. Just get a bowl of happiness.
Well, I do want to briefly hype. I have a full-on 1,100-word Netflix analysis hitting on the Morning Brief newsletter on Sunday. That's if my editor doesn't cut it down to 900 words. I hope they don't. But really it goes into, Brad, looking at why content like this, original content, is still so important to the Netflix story next year. It's not just a live sports thing. And I do make the case that the stock could still be undervalued despite the rise.
If it's cut down, just call it the Squid Games edit.
No, I'm going to take the 200 words and put it on my X account. All right, next, nonetheless, we're looking at the company on the cusp of $4 trillion valuation. That, of course, is Apple. Remember, to the bulls, the stock's recent hot streak could signal a pullback coming in January. Apple has seen 5 straight weeks of gains of more than 2%. According to a note from BTIG analyst Jonathan Krinsky, this has happened 7 times since 1990, and average returns 4 weeks later have been down more than 5%. I love data like this, Brad. I mean, you try to think, well, oh man, Apple's gonna have a bad 6 months. I get what they're saying, and I almost agree with it this time, Brad. They really don't have an event, Apple, until March, where they may unveil new iPads, a new lower-end iPhone, a new Mac computer as well with their newest chips. And secondarily, given that information void, you theoretically could have Apple shares dominated by various tariff-related comments from the incoming President Donald Trump. And you also have a stock trading above the 5-year average price-to-earnings multiple it has traded at over the past 5 years, almost about 5 times higher in terms of valuation. So, I mean, it makes sense. I do think it could follow this historical data.
Yeah, it's interesting within this note, and we're looking forward to speaking with him later on today, but just within this note, there has been massive dispersion below the surface, coinciding with a surging dollar and rates. Last week's drawdown he's mentioning was likely a shot across the bow. The world's largest company, Apple, closed up 2.56% last week, 5th consecutive weekly gain of 2% or more. 1-month forward returns following such streaks, he mentions, have been quite negative for the name here.
Yeah, it just needs another really catalyst here, Brad, and that catalyst may not come into March. And if you look in the near term, again, more tariff talk. I think there was a discussion recently. What is Tim Cook? How long is he going to stay there? That might come back into the forefront in the first quarter next year as well.
Yeah.
So it's hard to see that next positive catalyst to drive this stock even higher. And historically, it's hard once you get markets near round numbers, stocks near round numbers, it takes a while to push them through.
Well, the other thing, too, is the stickiness of the ecosystem is going to be tested, especially within a core market in China. And we were discussing this yesterday with regard to the IDC data that had shown for smartphone markets in China that there's more growth for Android in emerging markets and in China. That's a problem for Apple. It's a problem for Apple investors out there that are trying to make sure that not only is the baseline that they've come to expect in China continue to be securitized, but that the ecosystem is becoming stickier, especially at a time where they're rolling out even more of the artificial intelligence features, which I don't know if you have them in your phone. Mine is way too old.
If I do, I don't know how to use them yet. It's a relatively new phone, and I would rather not have a phone than use Android.
Is that a 14? 15?
No, I just got it maybe like 6 months ago.
You got a 16?
Maybe if I download, I have
Look
the
at
Intel.
you.
I don't want to use it. I'm old now. I don't have time for this intelligence
fresh
stuff.
tech.
All right, we're going to hear more from Jonathan Krinsky today when he joins Brad on Wealth at 11 a.m. Eastern Standard Time. I am pumped for that convo.
Finally here, let's talk a little Nissan. Nissan falling over concerns about the terms of its deal with Honda, according to Bloomberg. The Japanese automaker plans to establish and list a joint holding company with Honda by August of 2026. The stock dropped as much as 15%, sharpest intraday drop in 26 years before closing nearly 8% lower here. And if we could take a look here, a little bit of a broader chart here, because you can kind of see a little bit of that reversal in play here. I don't know if we can isolate Nissan, but a little bit of an island reversal, it would seem, at least, given the rise up that we had seen, and then now the drawback as well.
Shocker, two legacy auto giants coming together, and maybe the stock prices don't always go up in a straight line as this deal comes to fruition. Shocker! Whoa, like, wow, no. Like, there's going to be a lot of information coming at both of these investors over the next 6 months. This deal may not close, even if it goes through until late 2026. So this is a first, I think, many periods, Brad, where you can see some extreme volatility in Nissan and then Honda. Honda's shaking off today, but Honda, by all means, is not removed from potential volatility.
What do you call that sound effect you just made?
It's just like, I have all these sound effects in my head, Brad. I just want to get them out. I should just donate them to Yahoo Finance, and we can just play them at various times.
Well, what we could do is record them and then replace whatever the easy button sound is. And
Maybe that's our breaking news alert next year. Just breaking news. Breaking news.
Special report.
That's
Every
the sound. Oh my God.
We'll workshop it.
All right, straight ahead on Morning Brief. One strategist says he has some top fears investors need to know about for 2025, and that is not my breaking news sound. Don't go anywhere.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Welcome back to Morning Brief, everyone. We're taking a look at the setup going into today's trading activity here. And the Dow futures right now down by about 0.7%, just seconds away from the opening bell. We're also taking a look at the Nasdaq 100 futures. That's down 0.7%. S&P 500 futures, same on a percentage basis. This is largely how we started off yesterday's session, though, down for the major averages, but we were able to see reverse course and ultimately getting into positive territory, trying to add on to some of the Santa Claus rally here. Speaking of the Santa Claus rally, it can't start if we don't open the markets, and that's what we're doing right now. At the Nasdaq, you've got 9 million reasons ringing the opening bell at the Nasdaq, and you've got Bad Boy Mowers Bowl ringing the opening bell at the NYSE. Big time college football playoff energy time period pinstripe bowl. Sponsored by Bad Boy Mowers, I should say here, ringing the opening bell at the NYSE. All right, guys, taking a look at how we open up here on the day as I scroll up to the NASDAQ, the Dow, and the S&P 500. Just as we were seeing in the futures, fractional declines as of right now for all three. The Dow down 0.6%, NASDAQ 0.6%, S&P 500 0.6%. Let's see if we can find some bright spots here, or at least just give you a little bit more color going into the beginning of today's and beginning and kicking off today's trading activity. We're red across the 11 S&P 500 sectors right now. Consumer discretionary, that's pulling up the caboose. It's down the most by about 0.8%, but you've got fractional declines across the board. Energy is the least bad of the decliners. It's down by about 0.5%, but red across the board there. Let's take a look at the Dow 30 components. Surely there's got to be some green in here somewhere, and hey, look at that. We found it. It's Verizon Communications, flat, just barely to the upside here. You've also got Boeing. That is flat, barely to the upside here. So we'll see in that hyper oscillation where things ultimately net out as we see a little bit more activity get under the belt of today's trading activity. Let's take a look at the NASDAQ 100 here. A lot of red. All right, mega cap tech right now taking a little bit of a pullback here. Nvidia, that is down by about 1% here. As we're taking a look at the NASDAQ 100, we're also seeing ASML, that's moving higher by about 0.1%. And then additionally here, you're seeing a lot of the other mega cap techs, whether it be Microsoft, whether it be Alphabet, Amazon, some of those Mag 7 plays beginning the day in negative territory here. But also want to briefly take a look at some of the other EV plays. Why don't we here for a hot second while I locate the retail board? EV, Tesla, we mentioned that a moment ago, considering some of the move that we'd seen, and we're going to get into Ford just a little bit later on, but that's down by about 0.1% as we kick off today's trading session. And we'll ride out with a look at a market that never closes. Cryptocurrency. Bitcoin's up 0.6%. Saz?
Right, glad you mentioned Bad Boy Mowers. I just Yahoo searched them. I don't even have a lawn. I got to buy one of these things. Oh, man, for like.
Where are you going to put it?
I have no, maybe I just put it in my living room. This thing is, you got to check this out. All right, we'll talk offline. It's time now for today's strategy session. For more on the market action and what we can expect in 2025, we have Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, good to see you here. I think markets, to me, they just feel too happy. You know, I appreciate the positivity, but it can't continue. You know, as we look into next year, do you see any dislocations on the horizon for markets?
Yeah, thank you for having me. So here at Annex, the way our investment committee is looking at it is, you can enjoy the Santa Claus rally because I think that's typically what we have. I think it's about 80% of the time going back to 1926. The last 5 trading days and first 2 trading days of the new year are positive. And so that's a great thing, but you're right. The good feelings eventually do likely need to come to an end, and reality ends up slapping us in the face sometimes, and sometimes it's kind of hard. And I think that one of the big risks as we go into 2025 is really thinking about, FDR, his famous speech about we have nothing to fear but fear itself. And so if that sentiment changes, if all the things that have propelled the market higher since the election, prospects of deregulation, you have the extension of the Tax Cuts and Jobs Act, if those things maybe look like they're not a slam dunk or that they might be pushed out to a later date, that could be the dislocation opportunity that we're looking for. Because with that type of reality check, that could create a market correction, which then we would view as being quite buyable.
Brian, we were talking earlier about a note from BTIG that's rattling around in the markets here this morning, talking about a 6,100 level. Perhaps the S&P 500 can make a new all-time high into year-end, but also notes that January is likely to see some downside volatility. What would that volatility, from your perspective in the setup going into January, what could that potentially look like?
Yeah, that's a great question. And I think that a lot of it really does hinge on what happens around Inauguration Day. So if President Trump, does he come out swinging with tariffs? First day, what are the executive actions that he takes? Those are the things that it can really maybe shake the snow globe of the markets right here. And it's possible that it could be, a big rotation. In 2018 to 19, he started with the threat of tariffs and then implemented them after a period of time. But if now he starts with tariffs and then dangles the carrot of removing those, and if concessions are made, that's the type of thing that we think could actually make emerging markets a better buying opportunity. There is a real cloud overhanging emerging markets with China's slow growth, but they are beginning to offer some stimulus. And if we end up having tariffs that aren't maybe as bad as feared, perhaps that creates a decent buying opportunity there for people who have been long suffering through an overallocation or an overweight to emerging markets.
Brian, it sure seems like we have set the stage for some form of first quarter correction in markets. Tariff threats, unsure policy from the incoming president and his administration. Do you fear that at all?
Yeah, I agree with that perspective. I think that we are likely going to see something in the first quarter that is perhaps a little bit more intense than what we experienced just last week, where there was the drama around the Fed's rate cuts, cutting back on the pace of rate cuts, combined with the recognition that there's still gridlock in Congress. Even though we are going to have a red wave, or have had a red wave, that's not a blank check for the Republican Party or the White House to just plow through whatever they want. And so combination of those, I think, could come to a head in the first quarter. And it could be something that is, as some people would say, rather nasty, brutish, but thankfully short.
We've seen a mirroring of some of the same calls from analysts, from portfolio managers and strategists here going into 2025. But I want to get your outlook and your sectors that you think are positioned to outperform.
Yeah, and some of it, I think, is people who have been a little, I guess, maybe some sour grapes, that we haven't been overweight, the mega cap tech stocks and large cap growth. And so hoping and praying for a pullback to reallocate. But we actually think that sticking to a disciplined process, looking for those valuation opportunities for the long term. And a lot of those we think are showing up more in the industrials area, even materials. Generically speaking, I would say like the mid-cap quality space looks quite compelling because of the slightly lower valuations compared to large cap stocks. But you also have a better profitability profile compared to small cap stocks. So within there, looking at things like information security, software, industrials, we think that those are some areas to really be looking for some opportunities to overweight.
Should you be wary of unprofitable small cap stocks, though?
Yeah, one of the issues with the unprofitable small cap stocks is they can be unprofitable for a while and then have just amazing profitability, right? I mean, in that space, it can feel kind of like buying a lottery ticket, because you're buying something that is maybe a big payoff, but in the future, somewhat low probability. So we think it does make sense to still have some of that small cap unprofitable, provided that you believe in the business model. So one of the ways we like to play that is through an active manager in the small cap growth space, but they're the ones who really know the businesses and know the managers of the business, and that it does look like there is that runway to profitability. Because eventually you do have to really put up the numbers in order to justify shareholders allocating towards your company.
Yeah, well, a lot of the investors and early investors in quantum computing who had that in their playbook for this year, they're probably feeling like they have a lottery ticket this year. Brian Jacobson, thanks so much for taking the time. Appreciate it.
Thank you.
Heading into year end, we're tracking the performance of the 11 S&P 500 sectors, and today we're zeroing in on consumer discretionary. Yahoo Finance's Akiko Fujita is here with us in studio and has the details. Hey, Akiko.
Hey, good morning to you, Brad. Yeah, consumer discretionary sector outperformed the broader market on a sector-by-sector basis. It was among those top performers. Taking a look here, gaining roughly 30% year to date, but much of those gains came down to Tesla. So let's take a look at the top 5 names here. Amazon among them, Booking Holdings, TJX, and Home Depot. But you scroll down to Tesla and you take a look here. up nearly 80% year to date. Now, Tesla bulls will argue the company's always been a part of the AI trade, but this was the year where that really gained traction, largely because of the excitement around its robo-taxi, also known as the Cybercab, and that is reflected in the stock performance. So you start by at the beginning of the year, the stock dipped just a bit here on concerns around Tesla's demand in China. It remained relatively flat going into July here, but this is where we really started to see that AI trade take off. The initial announcement of a robo-taxi reveal in August pushed the stock even higher, and then we saw it push even higher into October. That's when the actual event took place after some delays. Now, there was initial disappointment following that event because Tesla didn't really show any advancement on its self-driving technology, but this is where the stock really took off. Yes, we are talking about the beginnings of that budding Elon Musk and Donald Trump romance. Musk donating more than $270 million to Trump's presidential campaign. And those like Wedbush analyst Dan Ives seeing Musk as the biggest beneficiary of Trump's policies around AI and deregulation. Now, there are, of course, other stocks in the sector besides Tesla. So let's take a look at where Amazon is right here. Up 47% year to date. Also a big performer driven by AI, and those gains being reflected in AWS's expansion. Amazon also launching several AI products in its e-commerce business. And then finally taking a look at a company like TJX here, of course, the value play, a big beneficiary in a year of cost-conscious consumers. That stock up more than 30% year to date. Now, looking ahead to 2025, you want to bring it back to Tesla. The company has promised a launch of its full self-driving technology in its existing Model 3 and Model Y cars. Investors are going to be watching closely to see whether Musk can actually deliver this time. Trump, of course, has vowed to rescind EV tax credits for buyers. That's some concern for EV makers, but Musk's proximity to Trump, he is expected to ride out any Trump-related headwinds, guys.
Kiko Fujita, thanks so much. Real good work there. Appreciate it. Coming up, the outlook for the economy in 2025. Why our next guest says storms could be brewing. That's next on Morning Brief. The economy may be putting up good growth and the stock market responding in kind, but there are a few storms beginning to take shape on the horizon, says our next guest. Mark Zandi is the chief economist at Moody's Analytics. Mark, always nice to get some time with you. What are some of the storms that you're talking about here? And do you think next year is the year that markets will finally start to take notice of our country's fiscal situation?
Yeah, I'm obviously focused on the possibility of broad-based tariffs and deportations. You know, both those policy moves would exacerbate inflationary pressures, put upward pressure on interest rates, and diminish economic growth. They're what economists would call a negative supply shock. Now, obviously, a lot depends on what those policies are and how they're implemented and over what period of time, but those are the storm clouds that I'm most focused on for next year in 2025.
Mark, you mentioned the immigration or what may happen there on that front from incoming President Trump. Take us through what is the ripple effect? If you deport those many people, what's the impact to the labor market? What's the impact to corporations? And what's the impact to the economy?
Well, it goes to labor supply. You know, we are in a full employment economy. The unemployment rate is 4%. It's been there for couple, 3 years. The labor market's been tight. A lot of the folks that have been coming into the labor force are immigrants. If we have significant deportations, and it would be actual deportations, maybe even self-deportation. You know, we're seeing, for example, businesses become much more reticent in hiring immigrants for fear that they might be deported in the future. That reduces the supply of labor, makes the labor market even tighter, creates wage pressures, price pressures, and makes it much more difficult for the economy to grow. And this is really key for lots of important industries. Obviously the agricultural industry, which goes to the price of groceries. It goes to the employment in the construction trades, home building, which goes to rents and the cost of housing, childcare, elder care, leisure hospitality, retail. These are all sectors that depend very heavily on immigrants. So if you see significant deportations and restrictions on that labor supply, it'll diminish growth and cause inflation to rise.
What does that mean then for the stickiest component of inflation, which has been shelter costs?
Yeah, it would put pressure on rents, and rents ultimately drive the cost of housing. You know, we have a very severe shortage of affordable housing, and we need to build a lot more homes. And actually, no sector of the economy is more dependent on immigrants than the construction trades. About 30% of all the workers in construction are immigrants. And that's nationwide. If you go into parts of the South and West, you'll see immigrant shares that are closer to 40, 50%. So, you know, if you see a lot of deportations and the construction trades can't build, we see fewer homes being put up. That adds to rents and prices and adds to the cost of housing.
Mark, I would love to know what you make of some of the pull forward in spending that businesses have been doing in order to get ahead of any potential tariffs that might impact their operations and their ability to source. How will that have a perhaps unintended impact, even if we don't see tariffs come forward, because now you've seen some of that capital be allocated earlier than anticipated?
Yeah, I haven't seen that. I mean, I've heard the anecdotes, no doubt about it. I just haven't seen it in the data. Now, it may be just a bit premature. The data is a bit lagged. The trade data only goes through October. The other data on investment and purchasing managers and spending only goes through November. So I would expect the pull forward effects that you talked about to start showing up this month in December and in January. So maybe a little early. But so far in the data, I really haven't seen it. I mean, we have seen strong Christmas sales, and that would be consistent with the idea of pull forward. The consumers, for example, are buying things a little earlier than they normally would, just because they're fearful of the higher tariffs and the impact on prices. But I'm stretching. So far at least, I have not seen that to any significant degree, at least in the data that I look at.
And Mark, going back to what we were just talking about, the country's fiscal position, of course, our ballooning debt position, which increases by the seconds. Doesn't it seem like it's time to address Social Security? And how would the government or the Trump administration even go about doing that?
I'm sorry, to do what?
Social Security. It seems like that is ripe for some form of reform.
Yeah, well, this goes to our broader budgetary problems. I mean, we have large, obviously, deficits, 6% of GDP, and that's a full employment economy. And funding Social Security is just part of that. There's only, only two ways of addressing this, or I guess three ways. One is we could grow our way out if we grow more strongly, but of course that goes back to policies like tariffs and immigration. And certainly there's no better way to grow the economy more quickly than rational immigration into the country, immigration reform. So that's one way. That would be the most desirable way. The other way is to raise taxes, and we're not talking about that here going forward. We're talking about more tax cuts, not tax increases. There's that would be a way. And the third is spending restraint, cutting spending, but that's pretty tough to do politically. And actually, when you get down to brass tacks, most of the expenditures are on things like Social Security, Medicare, and Medicaid, which are entitlements and very difficult to address. So there's no obvious way, no simple way, no smoking gun way of addressing the Social Security problem.
Mark, just lastly, while we have you here, as the markets were reacting to the Fed's pivot slightly, at least in tenor, and what the anticipations were for 2025 and future cuts, it seemed like the markets were rattled by that, and everyone trying to gauge what the Fed's mood ring might look like going into 2025. What are your top anticipations of the Fed going into next year?
I think they're going to sit on their hands. Going back to the tariffs and the deportations, that means higher inflation and weaker growth. So you're sitting at the Fed. What do you do with that? Do you respond to the higher inflation by raising rates or not cutting rates, or do you respond to the weaker growth by cutting rates more quickly? It's not unclear. It really does depend on the policies, the tariffs, how high are the tariffs going to go, on which countries, over what period of time, how much damage is it going to do. So with that uncertainty, which is going to be at a very heightened level, I think the Federal Reserve just says, I'm not moving. I'm just sitting where I am. And it's okay because they have cut rates a full percentage point from where they were back last fall. And, the federal funds rate target is pretty close to what you might consider to be the equilibrium rate, that rate at which policies either supporting or restraining economic growth. So it's okay, but I suspect we're not going to see any moves by the Fed for most of next year, certainly not in the first half of next year.
Mark, great to see you. Get a Capriati's cheesesteak for me if you can. Appreciate it.
Anytime. Take care.
Thanks. Coming up, everyone, we're taking a look at two stocks that are up over 1,000% year to date. Stay tuned. We're taking a closer look at some trending tickers this morning and move over SNL 5-Timers Club. Today, we're taking a look at a pair of stocks that are up more than 1,000% year to date, starting with quantum computing company Rigetti. It's up over 1,400%, and most of the gains happening just this month. Rigetti shares soaring since Google announced the successful test of its quantum chip Willow. And that news driving interest in the sector across the board here. The company, which counts NASA and MIT's Lincoln Laboratory among its partners, publicly launched the latest quantum chip, the Anka 3. It's worth noting that the company is not profitable and reported just $2.3 million in revenue in its most recent quarter.
Yeah, of course, it should be over 1,000%. All right. Anyway, and SoundHound AI up 1,043% year to date. Shares hit an all-time high this week. According to recent SEC filings, several top executives at the AI audio company sold stock. That included the CEO, CFO, and COO. Usually, that insider selling isn't a bullish sign, but we should note these trades appear to be part of previously planned sales or for tax purposes. Over the course of 2024, SoundHound AI inked deals to bring its voice AI to fast food providers. Torchy's Tacos, never heard of them, and Church's Chicken, did hear of them. Shares also got a boost back in March when Nvidia announced it invested in the company. Nvidia invested in this company? As of November, the company's expecting record sales of $165 million in 2025, above Wall Street estimates. That's news you can use there, Brad. That is just absolutely fascinating. All right, that does it for the morning brief. We'll be right back. Catalyst coming up with a key chat with one Tesla investor who thinks the stock warrant's getting cut in half. We'll be right back.
Did you say you'd never heard of Church's Chicken?
I've heard of Church's Chicken, just not the other one. Taco place? Never heard of that place. Don't even know what it is.
Welcome to Catalyst. I'm Brad Smith alongside Brian Sazi. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching in 2025.
Oh, year's not even done yet. First up, we're talking about what it will take to see large-scale adoption of AI and the challenges that lie ahead.
Plus, Warren Buffett holding his biggest cash position ever. We'll discuss where he and Berkshire might choose to deploy that cash in 2025.
And Elon Musk's position in the Trump White House. We'll discuss what Musk's new duties will mean for Tesla's stock price. Stocks slipping today on day 3 of the so-called Santa Claus rally. The major averages still on track for weekly gains. Joining us now, Keith Buchanan, Global Investment Senior Portfolio Manager. Good to see you here, Keith. Looking at one key theme throughout our show so far today is market dislocations and how they might arise next year, because as we know, stocks and markets don't go up in straight line. What are some of your concerns on markets as we enter the first quarter?
Absolutely, and thanks again for having me. We're looking at this from a multiple landscapes of just dislocations that have grown, and honestly, in our opinion, have grown problematic, whether it's from growth of value or some dislocations in consumer spending or even bonds and stocks kind of telling different stories. We feel like 2025 really could be a year where all those have to resolve themselves at one point or another, in one fashion or another. And at this point next year, we feel like most of those would have had some sort of resolution that might be positive for markets or perhaps even not so positive going forward.
And so with that in mind, as you're kind of looking across the best opportunities, there's been a lot of potential buying on the dip mentality that is brewing right now, looking for the next big pullback or waiting for the correction to potentially even come or more volatility in order to then set positions to hold for longer, even as long Mag 7 is already the most overcrowded trade right now, according to the BofA Fund Manager Survey. So all of these things considered, where, if we do see those pullbacks, are the biggest opportunities in your mind?
Well, we think those dislocations that have to resolve themselves will lay a bit of a map as to what are the most or the dislocations that could perhaps cause disruption and affect asset classes and stocks and industries in different ways, could offer opportunities going forward. We're looking at growth versus value, for instance. And if growth continues to outperform value, it makes the market even more top-heavy than it is. You mentioned Mag 7. We'd even broaden that out to some technology, consumer services, the AI trade altogether. As if the economy doesn't hold up and consumer spending doesn't continue in a way that continue to bolster GDP and keeps funds flowing in a way that the Federal Reserve can kind of stay on its path, growth is, in our opinion, extremely vulnerable. As that economic stress would hit those highest valuation names most certainly the quickest, and also threaten some of the story, or at least threaten to delay some of the story that we're seeing as far as investment spending that's kind of catapulted AI to the position it is now. So a lot of dislocations, honestly, are, Venn diagram overlaps a lot. And so, one negative move in one dislocation could cause a ripple effect that we think could cause a lot of issues in the stock market going forward. Not necessarily bearish. We think that 2024 and the trading of 2023 and 2024, that was somewhat one-sided in one direction up to the right, could become a little more balanced, if you will, among growth and value, even U.S. versus international as well.
Keith, a lot of the Mag 7 stocks that we were just showing on our screen, they're trading at record valuation multiples. So I appreciate what you're saying on valuation. Having said that, is now the time to take some profits on these names going into the new year?
We've been in that stance for several months, even quarters, where we've preferred large cap U.S. growth as an asset class and been there in a very overweight fashion. We pull that overweight back to more balanced work around U.S. growth versus value. And in the same token of what you mentioned, growth is at this point at a valuation dislocation from value that is historic. We've said that over the last couple of years, it's grown as a wider and wider dislocation. But going into 2025, we really look at value as having a little more of a story behind it than it has in the past couple of years. We don't want to be underweight, in other words, in our world, long on the world, short, if you will, that those stocks that could pose a risk to our performance if they outperform kind of going into 2025, given our overweight in growth in 2024 and 2023. So we looked at this year as the last half of this year as an opportunity to take those profits and move it more into a more balanced stance in value. And we really appreciate and excited about our positioning going forward in 2025.
Keith, we're about to talk about the consumer in a second here, but I guess from your assessment of the consumer and what we've seen over the course of this holiday season, what type of permeation are you anticipating, especially for the economy where a consumer has really been more minded towards experiences or services versus some of the goods that might be sitting under a tree or, next to a menorah or, next to candles right now this time of year, but come next year, it could be a different type of consumer mindset. What is your assessment?
Absolutely. We've been fascinated with the consumer development coming out of COVID, as there were a preference obviously for goods, home improvement, and that morphed into the experiences and more travel was in vogue. Travel is still kind of coming back, and some travel-oriented stocks we've talked about internally still have valuations that pale in comparison to the rest of the market. Kind of going forward into 2025, we've seen dislocation of spending from the higher earners to the more modest earners. Again, that split is kind of reminiscent of what we're seeing in the split between growth and value, and that the haves and have not being that much far apart as far as the spending and experience they're having is a risk for economics and therefore a risk for markets. We've seen that in Target earnings, Costco earnings, Walmart. They're all telling a very similar story, that spending has changed, not from goods and services that has already sort of played out, but from a different experience of those that are taking, most economics tell you that the lower earners take the brunt of the toll of inflation. We've seen that, but higher earners have really powered this market forward and been the fuel behind GDP growth that we've seen over the past couple of years. Will that continue in 2025 is something we're really working hard on understanding, because we feel like once that turns, it could cause even more risk for the markets, especially for macroeconomic growth and the posted GDP numbers.
Keith, great to see you. Happy holidays to you. Thanks for taking the time.
Thank you. Happy holidays.
Well, as the holiday season comes to almost a close here, we still got a few big days coming.
Not over.
Not over yet. We want to get a pulse of the state of retail and the consumer spending out there as well, knocking around. Data from Visa and MasterCard shows spending rising year over year between November 1st and December 24th here. And we've got a few areas that we're really keen on within both of these reports here. I'll focus more on apparel here because that was up by about 3.6%, and specifically online apparel, according to MasterCard Spending Pulse data, that was up 6.7%. More of a propensity to spend online. We were actually talking about this during Wealth yesterday with a guest on returns, on the topic of returns and bracketing, which I hadn't heard of. Maybe you're doing this. I don't know. Okay, you say what is it? So maybe you're not doing it.
No.
But it's when you buy multiple sizes of an outfit and then you just send back the ones that don't fit here.
Hey,
So
we got the time for that. We're working professionals.
I mean, you're not going in the store to try it on,
I'm
so
not bracketing.
you're just gonna buy something that doesn't fit you and
Who
stick
thinks
with
of
it.
this crap? I mean, come bracketing. Just buy the size. If you buy I shop
What if it
specific
doesn't
brands.
fit?
Well, look, for me personally, I buy specific brands, so I know what fits, I know what sizes. It's
true.
I mean, that just adds more work and clutter to your bracketing.
Yeah, old man, fist to the sky,
All right,
bracketing.
well,
what is
anyway, I don't think you can bracket with my category for me that I'm focusing on, electronics. I don't know, maybe you could buy 5 different TVs. And
You could.
You could, maybe 5 different 75-inch TVs and try to return them. Electronic sales in the MasterCard Spending Pulse data up 3.7%. Visa data showing electronics up 4.2%. So I went right to Yahoo Finance. I checked out Best Buy's stock price. Not doing that well. I can't say that I'm surprised because Best Buy has been struggling for really the past 2 years, has consistently posted underwhelming earnings, has lower guidance, had cautious things to say on its last earnings call in late November. So it left me wondering, Brad, what needs to happen for Best Buy stock to really start working again if it's not going to be a potentially better than expected holiday shopping season? I think the company has bigger problems on its hands.
The answer is your domicile. It's your house. It's your shelter. And until we see any massive unlocking of more supply, which I think there was some Redfin data out this morning that actually pointed to an improvement in supply, but we still need more homes. We still need more of the ability for people to think or at least feel like they're spending further into their home experience or revamping that. And I don't think that happens until we see a major kind of cataclysmic shift to home ownership by many people who are still renting because of the inaffordability of purchasing a new or an existing home right now.
That topic right there, Brad, sounds like a 2-hour special for wealth. I mean, that's just...
Yeah, we talk about it every day.
Yeah, no, that's killer. I mean, yeah, but more homes, you need TV, you need the Sonos speakers, you need more plugs, everything.
More Sonos speakers.
More Sonos speakers. But
you already have 11.
You may have hit on something, though. I think that's important. For Best Buy stock to work, maybe you need to start tracking new home sales and existing home sales. Pretty good stuff.
Absolutely. Comes up in their earnings calls, too, here. Coming up, everyone, we're taking a look at today's Yahoo Finance trending tickers. We'll give you the news behind the moves. That's next on Catalyst.
Now time for some of today's Yahoo Finance trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, look at computer and tech names off of new research from Canalys. The PC research firm sees a slowdown in PC shipments in 2025 to 2% from about 6% growth in 2024. The culprit, economic concerns all year, Brad. I've heard from various executives that I've talked to, the AI PC. And it's going to drive a big upgrade cycle for the industry next year. This data suggests that may not happen. And as a result, you've seen really the two primary PC makers come under pressure here. That's HP Inc., Stock's down 8% in the past 6 months. And Dell, Brad, I was surprised about. Dell stock down about 15% in the past 6 months, despite Dell really pivoting into AI servers and really being viewed as an more AI forward play than the likes of an HP.
Yeah, I'm glad you brought up HP because that was mentioned within their earnings call as well. Just the sheer rebound that all of these companies are hoping for within PCs, but we actually might be seeing a broader shift. And dare I say, the tablet might be the response that a lot of consumers are looking to right now, especially within some of the accessories that have really come online here. That's good news for some of the companies in Microsoft, the Surface. That's good news for potentially Apple as they're continuing to dive further into trying to make sure that the tablet is an option, at least for those who don't want to go back to carrying around or lugging around a laptop all day. But I think for PCs more broadly here, what we're going to continue to see, and this is based on the Canalys research, PC shipments to the United States, yeah, they grew in the third quarter of 2024, but looking ahead, they say the market recovery is expected to continue at a slower rate, though, than previously anticipated. Weaker momentum in the Windows refresh cycle, headwinds related to macroeconomic policies.
Yeah, what's been driving the PC demand really this year has been commercial PCs, or as people come back to the office, they need to refresh these computers. What has really struggled too, the printer market. And I was surprised to see Xerox make a play for Lexmark. I mean, Xerox is doing terribly. So it's almost like tacking on two just poorly performing organizations on together and hoping that they can save a lot of costs and money. But the core demand for printers may never come back.
I almost gave a cheap printer as one of those white elephant gifts just to see if people would fight over it, because people still do.
Well, I thank you for the printer you gave me. No, I was just kidding.
It's coming your way.
Thanks, Brad.
Next up, everyone, let's go to the skies here. Travel is flying high. An industry gauge of airline stocks is outperforming the S&P 500 this year thanks to the travel boom. The S&P Super Composite Airlines Index, it's up 60% this year. Compare that to a 27% gain for the S&P 500, marking the best year for the airline industry gauge since 2014. This has been massive, and we've had the opportunity to speak with Bob Jordan of Southwest. He's joined us here in studio. I've had the opportunity to speak with Ed Bastian of Delta Airlines, and all of them are really shifting towards what the premium consumer can provide to all of their operations, both in margins, but also just in customer lifetime value as well.
Yeah, Brad, I really enjoyed the last conversation you had with Bob Jordan, laying out the case for why the airline market may be good, not just next year or the year after, really for the next 5 to 6 years. But shout out to Connor Cunningham. He usually comes on our show from Melius Research. In a recent note, he outlined some of the drivers for this hot airline demand. Inflation has eased. You've seen services and expenditures or experiences continue to be a hot topic. Wealth creation, helping to drive more travel by the affluent. And then just corporate confidence starting to come back too as a result of the election outcome. Put all of these together, and I think you're understanding why you're seeing these travel stocks continue to do well. But can it continue, Brad? Have we seen peak travel recovery?
Well, and also who benefits the most from it? And unfortunately, right now, you still got even more of a question mark that is looming over the ultra low-cost carriers. I'm thinking about Spirit and I'm thinking about Frontier. Spirit, a company so embattled now that as you think about what has to take place for them to get past some of the bankruptcy concerns here and really move forward as an airline that not only has price as one of the levers that they can pull, but also has experience, even while everyone is going to be starting to expect more premium of a travel experience that they navigate through. What does Spirit need to do to invest further in, put more capital in at a time where they were already hoping for this infusion via a buyout or via a combination and merger in order to make sure that they can better compete with some of the top tier airlines out there?
You do a lot of work on the airline space, Brad. I mean, can you confirm that Spirit actually has seats on its planes?
Yes, they do.
that experience, but
That
to
is
your
one
point,
yes.
It's not good. And the thing is, what do you do with Spirit? Because they've just garnered this reputation as being a terrible experience. They can't trade up. They can't trade up market, really.
Yeah, Spirit has had one of the lowest net promoter scores in the industry for years.
At least they have a score.
They have a score. However, if you're anyone out there who keeps tab on the Spirit Airlines NPS, let's just go into a quick, shallow dive of that, because anytime you're looking for an NPS, you want it to be positive, because that means that you have more people who are contributing to the narrative around your company than detractors, and that's typically the way it weighs out. If I'm taking a look at comparably, they have a negative 56 right now.
That's terrible.
So
you can't stay in business like that. Shout out to Delta. I got a cheese board on my recent flight. I was pretty excited about that, Brad.
Really?
Nice. Yeah, it was nice. Came out like in a bowl, which is really nice.
We'll talk about that in the break. Guys, all your markets action straight ahead. Stay tuned. You're watching Catalysts.
This has been a big year for artificial intelligence. AI stocks have helped fuel the market rally, and everyday people have started to use AI more and more in their everyday lives. We're not yet seeing widespread adoption. Here to discuss is Gil Loria, D.A. Davidson, Head of Technology Research. Gil, always good to see you here. Always follow your work. You say next year will be the year of AI agents. What will these agents do, and will they be profitable undertakings for some of the players that are creating them?
So agents in two different meanings. So the academic technology meaning is an agent's going to be a software tool that helps execute tasks, even independently so. We're going to see some early examples of that next year that may not go quite that far. That'll be mostly current AI tools incorporated into corporate business logic. So we're going to see companies like Salesforce, Adobe, ServiceNow, et cetera, incorporate some tools that go a little farther than just summarizing or translating, but actually execute tasks on our behalf. And that'll give people a little bit of a sense, especially in a professional setting, what those tools can do.
Gil, you mentioned Salesforce. I really recently caught up with Salesforce co-founder and CEO Mark Benioff. Of course, asked him about pricing for these agents and agents more broadly. I want you to take a listen, and then we can react on the other side.
So I think that idea that agents can make our lives better, help lower the cost of a health organization, a bank, a consumer product goods company, a government, that this is really what's at hand.
So Gil, Mark, as you can imagine, very upbeat about the prospects for agents, or in his case, Agent Force, charging what, $2 per conversation. As you look towards next year, how will these agents impact the sales force, and then how do you think it will impact the stock?
So we think that Mr. Benioff is doing a great job marketing this new product, but in the process, he's getting investors maybe a little too excited. We don't think that this is going to be enough of a success to drive revenue for a company that may approach $40 billion of revenue next year. So I'm not sure this is going to be enough to accelerate revenue for Salesforce, which investors are now very excited about. And one of the reasons is that the pricing model has to get figured out. We're going to go from a straight subscription model, which is how most of these companies sell their software, to more of a consumption model, sometimes even an output model. And what Salesforce is suggesting now is a per transaction model. That actually scares customers because they don't want success to become a problem. If their users use this tool too much, then they're going to have an unpredictable bill. So the pricing model is still work in progress, and Salesforce is leading the way by proposing $2 a transaction, but that'll probably only drive very moderate revenue next year as customers get comfortable spending that way.
Gil, I wonder if you've done the assessment either for Salesforce or for the industry more broadly, the percentage of their existing client base that would need to buy into these new solutions in order for it to ultimately pass through to some of the financial performance and make the valuations make more sense.
Yeah, so I think the easy way to think about it is these customers are deploying AI tools across as many customers they'll use them. So they're going to start talking about 10, 20, 30, 40% of their customers using AI. That's different than those customers paying for AI. So the only way we're going to really know next year if there's broad adoption of AI is if these companies show accelerating revenue. Salesforce now is at 7-8% growth. Unless they get to 10, 11% growth next year, that'll tell us that AI adoption is still in very early stages, meaning there's usage, but not necessarily payment for those tools.
Gil, as you look to next year, what is the best AI agent play in your view?
Actually, it's one level down in the infrastructure. So we don't know which tools will be successful or get broadly adopted or take off. But what we do know is that all these tools require a data layer. Snowflake is going to provide that. They require observability. Datadog, Dynatrace will provide that. They require more code developer operation support. A company like JFrog will develop that. That's going to happen regardless of which tools are successful. The tools, as they start being successful, will have an impact 2-3 years down the road on companies like Salesforce or Adobe or Box. But in the meantime, it's the companies providing the infrastructure software that you're going to need one way or another to accomplish these AI goals.
It seems that executives are gleeful about more deregulation coming into next year. Does lax regulation pave the way for a potential big deal to play out from your perspective in the generative AI landscape or generative AI focused? And what's the most likely one?
Absolutely. So the loosening of M&A restrictions on large cap technology companies is very likely to happen next year. So let's put aside the Mag 7. I'm not sure they're going to be treated any differently. I think the incoming administration is probably going to have just as tough of an approach on those companies. But some of the companies we mentioned Salesforce and Adobe. Let's mention Oracle. All three of those companies are very likely buyers next year. They're going to go into the marketplace and find the tools they need, whether companies like JFrog we mentioned, or Braze, or GitLab, companies like this that can add to those bigger companies in what they do, and they can look for those in the small mid-cap range, and they'll be able to close those transactions, which under this administration, the outgoing administration, they have not been able to do.
Yeah, some of those companies, especially Oracle, have had a propensity to buy to grow or acquire to grow in the past. So we'll see if that is the case again. Gil, thanks so much. Appreciate it.
Thank you.
As we're counting down to the new year, we want to take a look back at technology, the largest sector on the S&P 500. Our very own Akiko Fujita is breaking it down. Hey, Akiko.
Hey, Brad. Yeah, this was the year of the AI trade in the tech sector. Companies that capitalized on the technology and proved their investments were paying off, got rewarded in a big way. You take a look at the XLK ETF here, up more than 20% year to date, but Nvidia, yes, the very clear winner. Let's take a look at the stock performance on that. up more than 170% year to date. The big driver here, the company's most advanced graphic processing unit, Blackwell. CEO Jensen Huang first unveiled it back in March. The stock is pushed even higher on strong demand for Blackwell, but we could start to see some of those concerns around production delays start to weigh on the stock even further going into next year. There have been a number of snags, as you've reported, related to the overheating of the super chip GB200 and the customized server rack. So investors are going to be watching that really closely here. Broadcom comes in a close second, and you see that stock is up more than 110% year to date. Yes, also a big winner here in the AI race, surpassing the $1 trillion market cap for the first time. It was a choppy ride to get there, as you see, but investors are cheering on Broadcom's leadership and their chips that are built specifically to accelerate artificial intelligence workloads. You combine that with its enterprise software and security solutions, and that's led to some big gains for the stock. Oracle, in many ways, the real comeback story in tech. Larry Ellison really building on the AI boom with Oracle's cloud infrastructure technology. They secured a big partnership with OpenAI in June and then followed that up with another big signing with Meta. And you see the stock here up roughly 60% year to date. Ellison touting Oracle's models as faster and cheaper than rivals like Amazon's AWS. Now, looking forward to 2025, we're looking to some of the names that didn't necessarily crack the top 25, but are continuing the march higher. Apple, a big one investors are watching here. Will it finally reach that $4 trillion market cap? It has been inching closer to that level. That's something that the market's been watching closely. Palantir, another one here, didn't necessarily crack the top 5 because of valuation, but take a look at the gains right there. More than 350% year to date here, and continuing to secure those big contracts in enterprise AI. Finally, another big theme that's likely to emerge in big tech, that is antitrust. Apple, Amazon, and Meta are all defending themselves against a slew of lawsuits, but Alphabet is going to be the one investors are going to be watching closely in the first half of the year. The company is awaiting both a judge's decision on remedies in the search case, as well as a ruling in the main part of the ad tech case, which coming from a different judge. But guys, that's going to be interesting to watch. You know, we have seen this stock still resilient. There's sort of the AI play that investors have been watching with Alphabet, but also the regulation side of potential breakup. So a lot of things to watch here, to say the least, in the tech sector.
That is very true. Akiko Fujita, thanks so much. Appreciate it. Tesla stock has been electric this year. Starting the year on a down note, the stock fell nearly 30% in the first 3 months of the year as EV sales growth slowed, and investors look for more improvements in full self-driving technology and greater details on robo-taxis and a low-cost vehicle. Now the stock is fully recovered, and then some, thanks to the election win by Donald Trump and CEO Elon Musk's involvement in the Trump campaign. Shares are up nearly 90% since Trump's victory. But can the gains continue? Ross Gerber is a longtime Tesla shareholder and the CEO of Gerber Kawasaki Wealth and Investment Management. Ross, always nice to get some time with you. I mentioned the three-letter word in there, CEO. Is Elon still running this company? And if he's really not running it, does that worry you as a Tesla shareholder?
Well, it depends how you define running the company. I mean, he certainly is setting the direction and the tone of the business and overseeing the senior executives that are in charge of all the different projects. But in the traditional sense of running a company like what's going on in Nvidia, no, I mean, he's not at all. And I think Tesla shareholders are more than aware that their CEO works for Donald Trump at this point. So you know, it's yet to be seen whether this team can prove themselves. The old team at Tesla, which I knew very well, was very capable, but they were all let go in the last year. So a whole new team has taken the reins here. And 2025 is going to be their year to prove if they can deliver, because they got a lot of stuff to deliver in the next, 12 to 18 months.
I mean, Elon Musk is essentially the face of Tesla. He is the face of Tesla. And so there had been concerns from investors for years about what Tesla would be without Elon Musk. So is it net positive or net negative if this team is able to prove that they can go forward and operate successfully without Musk?
Well, I think, Elon obviously is a manufacturing innovator of our time, and his, input and effort in the different companies that he owns creates, the opportunities that these companies have been able to achieve. So you don't want to discount what Elon's done by any means. But on the other side of the coin, he's got more, things going on than ever, and especially trying to, run the U.S. government, which is a whole nother monster. And we'll see how he does with in a whole new challenge, but doesn't take away the challenge of solving full self-driving, which Tesla still hasn't done. The new version of full self-driving, which I'm using 13.2.2, is quite good actually, and definitely an improvement over 12, but we're still not at level 5, and I still don't have the confidence I have when I get in a Waymo, and I'm taking Waymos now instead of Ubers every day that I use ride sharing. And so, I think there's a lot, as I said, that Tesla has to prove in the short term, and Elon not being there can't be helpful. So I have faith that there's great people at Tesla, and that's why I own the stock. But at the same respect, I see this with the valuations and, obviously a very high expectation level. Boy, Tesla's got a lot of hurdles to jump, over the next couple months.
Ross, you mentioned valuation on Tesla. It's sky high. You could just see the numbers. You go to Yahoo Finance. I mean, just levels not many folks have seen before on Tesla. How much of a Trump premium is baked into Tesla shares here?
Well, I don't know if it's a Trump premium. I would call it the robot premium. It's sort of like, well, we know the long-term potential of, let's say, robots and cybercabs could be, quite large. It's very hard to quantify that on the short term. And so, what we've been saying is that the traditional Tesla that we own, that business is worth around $200 a share. But when you add on autonomy and robotics, and you say, like, what's the cybercab business going to be worth in 5 years? It's really hard to tell. We can't put a value on that because I think it's going to be a highly competitive business with much less profitability than we'd hope. Robots, I don't even know if consumers will buy robots and what those will cost. So we don't know what that's worth, and that's why the market might be assigning $250 a share. Yesterday, now it's $230 a share of extra valuation based off hope. So that said, all the other great companies in America traded around 35 forward earnings, whether it be Nvidia, Broadcom, Microsoft, Apple. So you're looking at a pretty straightforward valuation for the great companies of America. So why Tesla deserves a 3 or 4x premium over Apple, Nvidia, Broadcom, Microsoft, which is all in my portfolio at GK, and we own, Tesla as well, but in a much lower weighting because we find this valuation to be a little bit crazy, and it's a meme stock, and that's what it is.
I just watched Subservience on Netflix, so I'm out of the robot purchasing game right now. I'm not part
exactly.
of that.
I'm not rushing to buy a robot either.
Ross, just as we think about something that you were mentioning a moment ago in full self-driving, more states need to come online, not just to pilot, but ultimately green light. What is the dial that Elon Musk can move in the ear of President-elect Trump once and after the inauguration takes place to really get this more federally looked at and federally greenlit?
Well, here's the problem. The federal government doesn't actually have authority over state roads. So you have interstate highways, which are part of the federal government, and then you have most states, all states have their own, it's the California Highway Patrol. It's not the federal highway patrol. Mm-hmm. So California sets its own rules, and they're going to set the rules that they want to protect the citizens of California. I'm a states' rights guy. This is a states' rights government, and the states have every authority to enforce safety for its citizens based off what its citizens want. So the federal authority more relies on overall safety for consumers, which the NTHSB and other federal agencies that have been investigating Tesla for some time. So this is where I think there's a big positive for Tesla, because these agencies have been biased against autonomy, and autonomy is really one of the greatest ways to improve highway safety. So I think on a federal level, there's a huge advantage of having the federal agencies off Tesla's back, because what they're trying to do is make roads safer despite, the political attacks of these agencies. But from approval of autonomy on roads is still going to be a state by state battle for Tesla. And, the United States is not the leader when it comes to, pushing EVs and autonomy like China, for example. And so federal government help by pushing autonomy onto the states would be a huge positive. But, once again, I don't even think Trump knows how to drive, nor he hates EVs. And I don't think he cares about technology that much. So, I think he cares as much as it matters in his pocketbook.
Ross, real quick before I let you go, I caught a post by you recently on Nvidia. Of course, Jensen Huang giving that CES speech in early January. You think that Nvidia is about to enter leg 2, I guess, of its growth. Will that second leg of the Nvidia investment thesis be as profitable as the current one?
Well, it certainly can be, because Nvidia is printing money like Apple did in the early days of the iPhone, where the growth, most people have a lot of, sort of limitations of like, oh, it can't grow that much bigger, and oh, how big is this opportunity? But then you look at what Elon's doing with XAI and how aggressive he's being, and I'll tell you, you want to follow what he's doing, like him or hate him, he knows technology better than anybody, and we're using AI on a daily basis for lots of useful and productive things, and I think we're just at the beginning when you think about how bad Siri is and how much better your phone and more productive work could be with AI agents and Salesforce and other types of programs that we all use every day within our business. The opportunity for AI is somewhat limitless at this point. So one must think long term, because Nvidia is not a highly expensive stock, but it's not a cheap stock. But the actual profits that they're driving and their monopoly position in the chip business just puts the next 5 years looking really good for Nvidia. I've owned it since it was a gaming card company over a decade now. It's been actually a better investment than Tesla over the last 10 plus years for us, and I feel very fortunate to be on this ride, but I certainly wouldn't get off it now. So for investors, Nvidia needs to be a part of your portfolio just as much as Apple, Microsoft. GK, my fund, is a great way to play it. We have AI, we have Bitcoin in our fund, we have consumer discretionary. A lot of the sectors that you were talking about in the previous segment is exactly what we're investing in. And this is a great time for stock investors, and you want to be long stocks here. It's the only game in town, U.S. stocks.
All right, Ross, now that you have all of our handheld devices lighting up by saying Siri, we're going to have to leave things there. Thanks so much. Appreciate it. Ross Gerber.
Yeah, thank you. Have a good holiday season here.
You too. Thank you. Coming up, everyone, why you might want to take a second look at healthcare and industrials going into 2025, plus one theory as to why Warren Buffett keeps adding to his cash position. We'll break that down next. The healthcare and materials sectors are two of the worst performing sectors on the S&P 500 in 2024. Our next guest says now, though, is the perfect time to take a look at what to expect from them in 2025. Thomas Hayes, Great Hill Capital Chairman and Managing Member, joins us now. Happy holidays to you. Thanks so much for hopping on Yahoo Finance with us. So you're banking on a bounce back here potentially with these two sectors. Why is that?
Yeah, Brad, thank you for having me. I think the theme for 2025 is going to be the last shall be first. If you look at healthcare, it's up basically 3-4% year to date relative to the S&P, some 25%. And with materials up 1.8% year to date, very anemic returns. But when the calendar turns, something is going to change, and that's called earnings growth. As a matter of fact, healthcare and materials are in the top 4 earnings growth expected for 2025. Healthcare is expected to grow earnings 20.6%. Materials is going to grow earnings 17.4%, which exceeds the S&P 500 at 14%. And, you know, Brad, if we look at healthcare, there's some strange things happening, but kind of predictable. We saw a similar situation in 2016, right after Donald Trump was elected. Healthcare and biotech sold off. If you remember, he was going to tear up the Affordable Care Act and the market got nervous. Shortly after the inauguration, healthcare rallied, biotech rallied. As a matter of fact, healthcare was up around 40% in 2017. Biotech around 75% after selling off after the election and then rallying after the inauguration. I think now it's not the Affordable Care Act, it's RFK Jr.'s got people a little bit on edge. And I think it's a case of sell the rumor, buy the news. It won't be quite as bad as people are expecting on the healthcare front.
What about the materials, Thomas? Good to see you as always. Aren't tariffs going to be bad for this sector?
Yeah, I think it's more than advertised. I think this is a negotiating tactic. If you look at materials, it has the lowest relative performance to the S&P 500 since 2020, and then going all the way back to 2001. These were both generational buy opportunities in the materials sector. And speaking of which, Brian, the materials sector, if you look at XLB, did the exact same thing in 2016. Remember, he ran as the tariff king. They sold off after the election. They rallied in 2017 after the inauguration. So we expect more of the same thing as it relates to just some of the technical stuff on this. You know, materials, only 7% of the components are trading above their 50-day exponential moving average. Now, I'm not a big technician by any stretch of the imagination, but that tells you the sector is completely washed out. And there's one player that we particularly like called Albemarle. It's one of the largest lithium producers. And if you know anything about lithium, it's very cyclical. Right now, it's at very low prices on the fears of a supply glut. We do expect this imbalance to be rectified by the end of 2025. Albemarle is one of the biggest players. They've got $3.4 billion of liquidity to wait it out while the smaller players will be crushed. So we do think Albemarle is going to be a great play. It's also down on the fear of softer, maybe potential or perceived softer demand for EVs in the developed world, like United States, like Europe. However, the EV game is all about China, and that's an unnatural government subsidized market, and that's expected to grow from 40 million stock globally, 41 million stock of EVs globally right now, to 132 million by 2027, largely driven by China and the government subsidies to push that. So that's going to help Albemarle. And even prior to that, you saw Albemarle could perform through all kinds of lithium prices, high prices, low prices, et cetera.
Certainly.
And this time will be no different.
Tom, I got to hustle to bar finish here, but just lastly, according to an SEC filing, Warren Buffett's Berkshire bought $28.5 million in Verisign stock, an internet registry company that's been around since the dot-com boom. You know, Buffett's moves lately, he's sitting on a lot of dry powder. What do you make of that? And how could it be deployed potentially? Where are the top areas he could deploy that in 2025?
So VeriSign is certainly a headline. It's 91 basis points of the entire portfolio. So you can see a lot of these moves are being made by the lieutenants, Todd and Ted. Buffett's got, some $325, $350 billion of cash. I think right now it's about preserving his legacy, going out like Seinfeld at the top of his game versus eking out a few extra percentage points of returns. He's got the greatest investor of all time, in my view. I think he's been cautious. I think there's a Buffett premium on the basis of sometime after he passes, perhaps the sum of the parts is greater than the whole, but Buffett never wanted the company broken up. So that's going to take many years, if ever, to break up. You're going to have to roll off a lot of the current board members before you see that type of makeup, or before you see a material dividend, which is something else people would talk about. So I think right now it's preservation, it's a victory lap. And it's going to effectively, it's the law of large numbers. It's going to effectively trade like an S&P index prospectively, unless they can really hunt down an elephant before his passing and buy a very large, high growth business at a reasonable price, which is not looking like a high probability event in the coming years.
Thomas Hayes, always appreciate the insights. Happy holidays. Talk to you soon.
Thank you. Thanks for having me, Brian and Brad.
All right, all your markets action ahead. Stay tuned. You're watching Catalyst.
The economic outlook for 2025 looking pretty bright, according to our next guest here. A new survey from ISM showing both the manufacturing and services sectors are expected to show revenue growth next year. Joining us now is Tom Fiore, who is the ISM Manufacturing Business Survey Committee Chair. Tom, great to have you here with us. So just take us into your outlook here, Tim, as you're kind of thinking through what this holds for manufacturing more broadly.
Yeah, thanks. So, once a year, this time of year, we do a pretty comprehensive forecast for the coming up year. And we also do a look back at what happened in 2024. We look at revenues, outlooks, we look at cost inputs, and we look at investments. So, going into 2025, we're looking at a 4.2% manufacturing growth for 2025, which is pretty consistent with what we were seeing back in 2018 and 2019. But not as strong as what we thought we would be in 2024 back in a year ago. So, but the outlook overall is very positive, with a diffusion index out in the 64 range. So that, if you think of the PMI at 50 means you're the same from the prior year. We're saying from an outlook standpoint, 2025 is going to be significantly better than 2024. And we also believe that that's going to happen primarily in the second half of the year. So overall, the revenue side seems to be pretty robust. It's consistent with the 2019 economic performance, which your listeners may not know, but that was a year that we were actually in a manufacturing contraction after several years of a pretty good growth under the Trump early administration.
Tim, from what we've heard from President Trump and various people in his sphere of influence, do you think this time around he will bring back blue collar jobs to the U.S.?
Well, I think that's why probably our forecast isn't more optimistic. When we were putting this together, I was expecting that the number would be closer to a 6 or 7% for 2025, given the fact now that we have an administration that is business friendly, fiscal policy that will be positive for the business community, and we have the monetary policy that is moving towards accommodative. So I would have thought that we would have been closer to a 7 to 7.5% revenue growth in 2025, but we're not seeing that. And the reason we're not seeing that is there's just so much uncertainty here. And as you know, when you put together a business plan, you don't put it together with a bunch of caveats. You have to post it in the ground. You start the year in January, and you have to perform against it, regardless of what comes up within your control or outside of your control. So I think the forecast being a little bit more conservative here reflects the fact that there's a whole bunch of stuff that are outside of the business community's control. They know it's going to be a growth year. How strong will it be? We'll see. With respect to your, bringing back more manufacturing jobs to the U.S., that's going to take some time for sure. That's not going to happen overnight. Obviously the tariffs are probably a significant short to medium term headwind for the business community. But so for instance, we're still forecasting a 3% price growth on material in 2025. And in 2024, we saw a 3% price growth too. In the case of employment, we dropped our headcount in 2024 by over 1%, and we're only planning on getting back about 0.8% of that.
Yeah.
And our labor and benefit costs we're expecting to grow by 3.2% in 2025, which is lower than 2024, but still well off the norm of 2 to 2.5% that we've seen over the last 15 years.
Tim, we only got about 15 seconds here. Mass deportations, impact on manufacturing, any from your purview?
Well, it is mass deportation for sure, because you're taking consumers out of the economy, besides the fact you're probably losing a bunch of labor that can do work in the U.S. But the biggest issue there, if it's a significant amount of people, like in the millions, you're going to be taking buyers out of the market, which is going to depress the demand. And right now, we feel pretty good. Demand started to come back in November. We'll see what happens in December. Our PMI report's getting released a week from today. But you take that many people out of the economy, and it's going to hurt.
Tim Fiore, thanks so much. Appreciate it.
Thanks.
All right, coming up is Wealth, our show dedicated to all your personal finance needs. Brad has you for the next hour, and we'll have a convo with a market watcher who is concerned about the bullish trade in Apple. I will be tuning into that.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're taking a look at your portfolio in day 3 of the Santa Claus rally. We'll discuss finding opportunity in overlooked areas of the market and zeroing in on small caps. Do small caps fit in your portfolio? One of our guests will reveal why now might be the perfect time to consider investing. Plus, taking a look at the housing market, we'll discuss the outlook for mortgage rates and prices in 2025. All that and much more during today's show. But first, let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks falling today to close out the holiday shortened week. We still got some time left in trade, but we are down right now, giving back some of those gains that we've seen during the Santa Claus rally thus far. As we're continuing to evaluate the midday and intraday declines, joining me now, we've got Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager for Equities. Matt, great to have you here. All right, so the Santa Claus rally still got a couple more days in it potentially to make up for some of these declines, and we still got some trading sessions left. But even in pullbacks like this, where are you finding opportunity right now?
Well, good morning, Brad. Thanks for having me back. Looking at kind of where we see value right now, it's kind of away from just cap-weighted S&P 500. And the reason being there is just the level of expectations that are priced in to the S&P 500 as we look forward to 2025 and the price that we're paying against those elevated expectations. And so just to kind of paint that picture a little bit more specifically, investors are expecting acceleration in earnings growth in 2025 to the tune of 12 to 13%. And against those fairly strong earnings growth expectations, investors are paying north of 22 times forward earnings for that. Contrast that with small caps. If you look at the small cap earnings picture, we're roughly 20% below the earnings base that was established in 2022. And against forward expectations, we're paying a pretty discounted price relative to the S&P 500, around 15x or so. Our thesis is simple. It's that if you look at kind of the path to beating expectations, we think it's simply just easier in the small cap space versus the large cap space. And if for whatever reason expectations are not met, you do have a valuation cushion on your side if you're looking at the price you're paying for small caps today relative to U.S. large caps.
And so all these things considered, as we're thinking about some of the areas that have been hot for 2024 and where that's expected to remain the case here, even if at some of the pricey valuations that you were mentioning, where are you expecting much of the 2024 trade to continue to prevail in 2025, and especially as we're kind of thinking about some of the most overcrowded trades at this point?
I think the forward path from here it's an interesting setup. And as we kind of look forward for the path of the economy into 2025, there's a couple of areas that we think you can do well as an investor in a variety of outcomes. Specifically, if you look at the economy on a go-forward basis, if the Fed is able to continue to reduce interest rates, and right now it looks like there's likely to be more of a deceleration in the pace of cuts as we look forward to 2025 versus what was expected just when the Fed started to cut rates back in September. In that environment where the Fed can resume those interest rate cuts, we do think that the economy can broaden out a little bit. And if the economy broadens out, we think the market breadth can also broaden out as well. And so, to us, that's attractive if you're a U.S. small cap or a U.S. mid cap investor. Conversely, if that does not happen, to the point of your question about kind of continuation, we think that, really embracing diversification makes sense if you're an investor. And the reason being is that we don't necessarily think the sustainability is quite there for 2025 and beyond if just a narrow slice of the economy and a narrow slice of the stock market are kind of where the strength is across both the market and the economy. And so for us, it's a reason to be diversified, as well as getting some upside in terms of if the Fed can continue to cut rates in 2025 to rotate into U.S. small and U.S. mid-cap exposures.
Yeah, as you mentioned the economy, I wonder, which landing camp are you in?
Right now, we continue to be impressed with the resiliency that the U.S. economy has demonstrated. And really, it kind of comes down to the amount of stimulus that was pumped into the economy persisting as we look at kind of the economic performance in 2024. To us, we think, though, that the performance of the economy and what slice of the economy we're in is really just determined by how interest rates have impacted your personal situation. If you have a locked-in mortgage, from the pandemic era, and you're paying, roughly 3% or so, you didn't really feel the impact of higher interest rates today versus someone who didn't own their own home. In fact, if you look at kind of who's doing the best in this economy, it is wealthier individuals that own their own homes, that have excess cash balances, that are earning higher interest rates against them, not lower income consumers that are feeling kind of more of the inflationary impact and paying higher interest rates on credit card debt. So, to us, it just speaks to the sustainability aspect of kind of the setup here today. If we're able to see interest rates move lower and the economy broaden out, because the labor market has stayed resilient, we think that there can be a path towards a soft landing, and we are seeing some indications that the floor of the economy, even if we don't necessarily get that, is fairly less sensitive to kind of what we would have expected a couple of years ago. And so it's a long-winded way of saying is that if we don't get a soft landing, we think the impact from a macro perspective is pretty mild in terms of a slowdown.
Matt, thanks so much for taking the time here with us. Happy holidays to you.
You too.
Heading into year end, we're taking a look at the performance of the 11 S&P 500 sectors. Today, we're zeroing in on financials. Here with more, we've got Yahoo Finance senior markets reporter Inez Ferre. Hey, Inez.
Hey, Brad, and financials has had a stellar year. If we take a look, financials is up 29% year to date, outperforming the S&P 500 right here, number 2 out of the 11 sectors of the S&P 500. And if you look up in right after the elections in November, you saw it really skyrocket higher, and you saw XLF hitting all-time highs. A lot of this has to do with expectations of a lower rates, increasing economic activity, more lending, less credit default risks if the economy grows, and less regulation from the incoming administration, more corporate deal making, mergers and acquisitions, IPOs, all of this which benefits the banks, the financial institutions. And looking at the best performers this year, I'm going to pull up one of the Dow performers, and that is AXP. AXP is up 60% year to date. This is a company that speaks to the strength of really consumers, spending, travel, businesses. And over on the banks chart, I'll show you some of the big performers being Goldman Sachs. Let me pull up a year to date. Goldman Sachs up 48% year to date, also hitting new highs in November. You also have Wells Fargo hitting all-time highs this year, and Wells Fargo up 44% year to date, which also speaks to the strength, again, of the consumer, because it does have a consumer unit as well. And then JP Morgan, all-time highs as well. So look, the banks overall this year did very well. Next year, going into next year, if there are signs of a soft landing, if the economy does continue to grow, this will boost consumer confidence. It will also boost business confidence. So there's quite a few tailwinds going into next year for the banks. And remember that also, if there are any type of corporate taxes from the new administration that's coming in, this is also likely to benefit banks. Brad?
Inez, thanks so much for breaking this down. Really appreciate it.
Thank you.
The holidays may be coming to an end, but according to our next guest, 'tis the season for small caps. Jonathan Krinsky, BTIG Chief Market Technician, joins me now. Jonathan, great to grab some time with you. So what do we typically see from small caps at this time of the year?
Yeah, so the average pattern, and again, this is, if you look historically and kind of blend all the years together, in both absolute terms and relative to their large cap counterparts, small caps tend to start to move higher around this time of year, and that strength tends to lead until late January, early February. And again, that's both in absolute terms and when you're comparing it to the S&P 500. So, the setup is there given their poor performance, again, both in absolute and relative terms up till this point over the last year. I think you can see a bit of strength there. Now, obviously the move post the Fed reaction, and even today is not, is going against that thesis, but I still think there is some hope for small caps here.
Within that, what type of profitability indicator should investors be using as kind of their barometer in what makes some small caps different than others?
Yeah, so there's various different ways to look at small caps. I think the two big sectors within small caps are financials, which are a lot of the regional banks, and healthcare, a lot of biotech. And so both of those are very interest rate sensitive. And so I think part of the headwinds that small caps have faced over the last several weeks has been the surge in interest rates, with 10-year yields moving back to around year-to-date highs. So I think, we really need to see interest rates moderate and probably pull back a little bit for the small cap trade to work, and that should benefit those two sectors.
Jonathan, you also had a little bit of a note of caution about Apple's performance following its 5-week rally. What are your expectations from the world's biggest company here in Apple, and how they can continue to perform after such a feat?
Yeah, so it is approaching that $4 trillion market cap, which would be the first time ever, as we know. But over the last 5 weeks, again, not including this week, Apple was up each of those weeks 2% or more. And that's the first time that's happened since April 2010. And if we look back since 1990, there's been 7 such streaks for Apple where it gained 2% or more for 5 consecutive weeks. And the 1-month forward returns are actually pretty negative. They've been down 6 of 7 times for an average of around 6%. The one time where it was up a month later was in April of 2009, coming off the great financial crisis. So, I think that's a bit of a different setup. So the thought here is it's had a great run. As you get around that round number $4 trillion market cap, perhaps that's a reason for a pause. And as you get into the new year, there's some perhaps tax selling implications. So I think January could be a little bit of a pullback for Apple. Again, nothing that would shake the long-term trend, the upward trend for Apple, but I think a reset certainly makes sense to us here.
Is it as Apple goes, the rest of the market will go with it too? I mean, you within your note had mentioned S&P 500 could see 6,100 before year end or early in 2025 as well, but that we could see a potential pullback after that.
Yeah, it's another interesting stat is that when the S&P has been up 20% or more on the year, of the last 5 times that's happened, January has been down 4 of those 5 times. So again, it's just a bit of maybe profit taking, what have you, and especially you do often see some of those winning stocks from the prior year get sold, and so perhaps we can get some rotation right out of mega cap tech into the lagging sectors. I think that's been something that's been elusive all year. That those rotations tend to be very short, and so perhaps we can get a little bit more of that in January, where you see stuff like energy and materials get a rebound while mega cap tech sells off. So yeah, I think if Apple goes lower, S&P and Nasdaq are going to go lower. There's a chance you could see small caps actually go higher in that tape, but we'll have to see. But yeah, I think S&P and Nasdaq do have some vulnerability here heading into January.
Jonathan, just lastly, while we have you here, as you think about the setup going into 2025, I wonder what that kind of signals to you and creates in terms of your top idea for 2025.
Yeah, we don't tend to put out top technical ideas. But I do think it's going to be a bit more tactical in nature. This 2023 and 2024 were pretty much set it and forget it for mega cap tech. So after 2 strong years for that, I don't foresee a smooth sailing uptrend for mega cap tech. I think there's going to be a lot more rotations, a lot more tactical activity. So that's probably our best idea without giving anything too specific.
Okay, I appreciate that. Jonathan, thanks so much for taking some time here with us on Yahoo Finance. Would love to catch back up in the new year.
Thank you. Happy holidays.
Happy holidays. Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are roughly 2 hours into the trading day. It's time for Yahoo Finance's Market Minute. Tech stocks dragging down the broader market. The Dow down more than 400 points. The Nasdaq seeing the steepest losses on the day, down 2%. 3 trending headlines we are watching today. Treasury yields hovering near 7-month highs as investors look to resume a rally into the end of the year. The biggest move on the longer end of the curve, the 30-year near the highs set back in April. Shares of home health care services firm Amedisys popping after it entered a new agreement with United Health to extend the deadline for closing their $3.3 billion merger agreement next year. And Netflix's Christmas bet paying off. Its 2 NFL games attracted 65 million people, setting records for the most streamed NFL games. Wednesday's matchups, the first in a 3-year deal between Netflix and the league. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. More wealth when we return.
Housing affordability is set to end the year in a tough spot. As mortgage rates continue an upward trend, the 30-year fixed rate ending the year at 6.85% according to Freddie Mac. Inventory is another challenge weighing on the market, though it is improving compared to last year. Active listings are up 12% year over year according to Redfin. Here with his perspective on the housing market heading into 2025 is Jason Waugh, who is the president of Coldwell Banker Affiliates. Great to have you here with us. And as we think about the affordability issue going into 2025, is there any sign that we could see this pressure ease?
Yeah, well, Brad, thank you so much. Great to see you. Happy holidays to you. Certainly, there are some leading indicators that support some optimism as we end 2024 and transition into 2025. We've seen pending home sales growth consecutive the last 3 months. November existing home sales reached an 8-month high, and its 6.1% year-over-year growth was the largest annual growth since June of 2021. So as inventory continues to grow, which you mentioned, certainly we expect affordability to ease.
All these things considered, as we're thinking about the supply that needs to be brought online, how does that need to continue to shift in order to really meet the demand for people who have been on the sidelines as of this juncture? And how will that ultimately help out, at least a little bit, on the affordability side too?
Yeah, you hit the nail on the head. And certainly it's not a demand issue. Again, those numbers that I just reported certainly support there's enough demand. Supply is the issue. I think at the end of the day, what we all need is just stability and less volatility in those interest rates. Industry analysts have reported or forecasted 2025 somewhere between the mid sixes is where the rates will be throughout the year. And I think at the end of the day, as long as they're less volatile and stable, we have a tendency to adapt. And as inventory continues to rise, single family inventory has risen 26% year over year. That's still about 15% fewer than same time 2019. So there's some room to grow there in the supply. But we've seen some growth in consumer confidence. And the last National Association Home Builder Housing Market Index shows builder sentiment still positive, and its expectations on future sales actually reached a 3-year high.
You know, as you think about the luxury side of the market here, it seems like there continues to be more optimism for affluent buyers. What are some of the top trends that you're seeing there?
You're right. The largest sales gains continue to be in that higher end. Homes valued $1 million plus saw almost a 25% year-over-year increase in November. So, you know, that community is certainly less dependent on the interest rates, and so you can negotiate solid deals there. But ultimately, we've just seen continued growth in that million-plus market across the country.
And so, how does that also impact where we're seeing more of that buying, that purchasing activity take place? Because it seems like there are not all hotspots for real estate are created equal, of course, as we do know.
Yeah, you know, that's one thing that we've really tracked the last couple of years, and it'll be interesting to see that movement if there finally is that shakes loose, is that migration patterns that we've seen from the Northeast to the South or the Midwest to the Southeast. That really has not happened in the last 2 years or so. And so really going to take a hard look at, are we going to see that movement take shape and come more into historical patterns from a migration perspective?
Yeah, really interesting. And then just lastly, while we have you here, what is your top expectation, especially for new and first-time home buyers and hopefully us millennials?
Well, again, I think we'll continue to see inventory and that supply grow, which will be a good thing across any price point. I expect, and there's no reason to doubt any other industry and analysts, that we'll continue to see price appreciation at a decelerated pace, and expect a modest increase in home sales. So up across the board in 2025, but will be modest.
Jason Waugh, thanks so much for taking the time here with us. Really appreciate it.
Thank you, Brad.
Absolutely. Final check of the markets here before we head to the noon portion of today's trading session. Taking a look at the Dow, the S&P 500, and the Nasdaq, we are down across the board. Deepest declines for the tech-heavy Nasdaq, down 1.9%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes up 3 p.m. Eastern Time. They'll count you down to and through the market close.
Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Be sure to share your thoughts in our comment sections, like Opening Bid on YouTube, and hit us with those 5 stars on Spotify and Apple Music. We appreciate your support. Now, as the new year rapidly approaches, we have our eyes locked and loaded on one thing, AI. No matter what the conversation is about, we find all roads lead back to technology that has been adopted faster than the internet itself. So for today's special episode, we're bringing you key conversations on AI from 3 different lenses. Nvidia's exponential success, hype around AI startups and the enterprise landscape, and physical tech products, or IRL, as the kids say these days. First up, the market's AI darling, Nvidia. The company's stock has tripled in value this year, making it one of the best performing stocks of this year. Some of its big news, you ask? Nvidia entered the Dow at the beginning of November, booting out the index's namesake, Dow Chemical, in the process. The company has also seen brisk demand for its new AI chip Blackwell and secured the coveted Yahoo Finance Product of the Year award as a result. 22 Research Managing Director and Head of Derivative Strategy, Jeff Jacobson, joined us on Opening Bid before Nvidia's November earnings were released. He offered great suggestions on how to approach investing in the company. Take a listen. Take us through how someone like you and your background, how do you approach an Nvidia earnings day?
Sure. Well, first we'll start with the Nvidia itself. Implied move tonight on earnings is about 8.25%, which on the surface you look at it and say, okay, it's Nvidia 8.25. It seems pretty fair. I look back the last 5 quarters, the average move was 7%, so 8% justified. However, a little digger, deep into those numbers, 2 of those quarters, you had a 16% jump in February when the stock was 67. The stock's now 147. You had a big jump in May when the stock was 95, and now again 147. So it's going to be a lot harder when you have the 120% gain since February, the 55% gain since May, to get that type of move on the number. Not to mention, at a 3.6 trillion market cap
that
now,
number's huge.
yeah, versus
that number?
again back in February, the market cap was closer to call it 1.5 trillion in May. So the law of numbers starts to work against it. Now, I'm not saying that the stock can't have another big move, but when you have a $3.6 trillion stock and you've had the success that the stock has had year to date, it just gets harder and harder to keep kind of, getting higher, especially when the bar is raised where it's been.
So you're sitting at your desk. How do you approach Nvidia? Because I think a lot of folks, when they go to Yahoo Finance, they see Nvidia, they'll look at P ratios, they'll look at multiples, they'll study earnings and profit trends. But I imagine, given your trading background, you approach it a different way. Like, what screens do you set up? Like, what does that look like?
Yeah, I mean, I look at volatility for, that's my go-to, and kind of, like I said, I'll look at the implied move first. I'll look at what the stock has done in the past, and then I'll look at not just where the weekly vol, the at-the-money straddle, that's again 8.25% move, but I'll look at further months as well, and then from there I'll kind of dictate, to myself, what's the best trade. So that being said, I'm kind of not in favor of buying expensive weekly vol here, again, just because of the size of the company. It's getting harder to move. Unless you really think it's going to have a dive, you probably want to stay away from expensive vols.
Are you a big chart guy? And I ask that because if you go back and look at Nvidia's chart, at least on Yahoo Finance, let's say 6 months, I mean, the stock hasn't moved a lot since, late summer? Like,
Yeah.
What does that tell you?
I mean, yes, it hasn't moved a lot, typical for the move everyone expected Nvidia, which was, just gain after gain. But I think that draws me into one of my ideas. We'll get to that in terms of the SMH. When you look at the entire semiconductor complex, that's really been, down, decimated.
I mean, you look at AMD, you look at, I think it was Qualcomm, all these AMD's really been.
The semiconductor equipment companies, AMAT last week got hit pretty hard on earnings. So I think the strength in Nvidia, trading basically at the highs, is masking some of the real weakness we've seen. Now, you can argue Nvidia AI play, the other companies are more levered to industrial, the phones, computers, what have you. But because Nvidia is such a high weighting in the SMH, it's really masking, I think, the weakness that we've seen from other parts of that group.
Then does an Nvidia investor, these people, we talk to these folks all the time, they love Nvidia. They are obsessed with Nvidia. I mean, this stock has made them a ton of money the past 5 years, even the past year. Should they be taking more of their cue right now from the weakness in semiconductors more broadly? What I'm trying to get to is semiconductors suggesting something brewing for Nvidia?
Yes, but the argument that I think the bulls will have is say, well, it's a different industry, the AI growth, the capital spending that we're seeing from the major companies. So maybe we are seeing that spread between Nvidia and the rest of the complex is deserved because of the growth and the money going there. Not to mention, probably as we see weakness in some of those other semiconductor names, the money will funnel towards what's working, which is basically Nvidia in that space. So I think it's going to be more of an if-then. We'll see how the earnings play out. If the earnings disappoint our guidance or the expectations were too high, then the bears will say, see, the other semiconductor stocks were signaling that. And if it's bullish, then the bulls will argue, see, where we shouldn't be kind of grouped in that same category, which is why the earnings, again, are always important.
Do you sleep the night before an Nvidia earnings? Like, I mean, do you get nervous about some of these calls? It's just like.
I think it's more excitement that, this is what everyone in the market wants. It's the action. It's trying to forecast it. My job is to look at purely the vol component and make an assessment. Is vol rich? Is vol cheap? one other trade, going back to Nvidia, I think.
Keep them coming. This is great, man.
I wanted to point out, I mean, everyone loves Nvidia, and for good reason. It's probably been the main reason.
It's printed money. It's been like a CD, except this CD pays 30% every time it reports earnings.
Right. If you've owned it, you love it. An interesting dynamic, Nvidia, that I wanted to point out, not so much in the weeklies, but if you go out for longer, is upside calls are expensive to puts. Probably a function of some of the gains we've seen on earnings. Maybe it's a function of the FOMO of I don't want to miss the upside. Maybe you're seeing people sell some stock and buy calls as a replacement. Whatever the case is, I looked in December, and the upside call in Nvidia is trading at a higher vol than the puts, meaning stock closed at 147 yesterday. As an example, the 160 calls, 13 points up, are trading at the same price as the 137 puts, 10 points down. So that's giving you an idea of the favorable skew, if that we call it, where calls are rich to puts. If you are nervous and you own it and you still want to have upside, but you want to have that downside protection, that's a really interesting trade because you still have some upside, almost 10%, if you sell that call against your stock and buy that protective put. And it trades for even. So the stock does nothing, there's no harm, no foul. If you get a move lower, then you have that protective put at 137. The stock was 138 on Monday morning. So we can see and have seen volatility. And it doesn't mean necessarily you need to even sell that 160 call. You could sell a higher strike call. It would trade for a debit. But again, knowing that calls are expensive to puts, stock's up a ton this year. It's at the highs. This is the weakness we saw in semiconductors. So that's another trade, speaking specifically on Nvidia, that I think as a collar or a protective collar, it's a really interesting setup.
I just got a mention in my ear from our fabulous producer. Can you define a put and call for the average investor?
Sure. So a put gives the buyer the right of the put to sell the stock at that price. So let's go back to the Nvidia trade. The 137 put means if the stock goes below 137, you get the right to sell the stock at 137. So if the stock goes to 125, you sell it at 137, you make the $12. And the call is just the opposite. It gives you the right to buy a stock if you own the call at a price. So if you bought the 160 call and the stock was trading above that, you effectively make all the money above the 160 strike where Nvidia is trading. So you buy it, you're effectively buying a 160 call. At the stock trading 165, you effectively buying it, own it $5 cheaper. That's your profit.
That was 22V Research Managing Director Jeff Jacobson on Nvidia. More of our special AI roundup coming to you after the break. Welcome back to Opening Bid, peeps. Next up, is AI overhyped? We evaluated the landscape of startups and enterprise-level AI companies with C3 AI founder and CEO Tom Siebel. Siebel is an OG in tech, so his views have gravitas. In no certain terms, he explained why AI is overhyped, calling out many founders for thinking that they're creating God in a box. Check it out. When I connected with you in January of this year, I mean, there was hype around AI. Everybody with the World Economic Forum and Davos was talking about AI this, AI that, AI risks. But wow, I mean, since then, things have really gone through the roof. I mean, how do you see it from your vantage point?
Well, there's you know, as it relates to kind of the AI writ large, I mean, this is a secular change. This is not ephemeral. It's a genuine big deal, probably a, you know, a couple $1 trillion addressable market. I mean, this is big, you know, or a couple of, $1 billion addressable market. But you know, what's going on with generative AI right now is, you know, it's getting pretty frothy. I mean, this is an important technology. It solves some very real problems. For those who are interested, you know, I've been looking for a good book on this subject for the last couple of years, and you know, somebody finally wrote one. A guy named Stephen Wolfram, who is a kind of very important member of the Academy, a physicist from Caltech, wrote this book. You know, what is ChatGPT doing and why does it work? Well, it's really not ChatGPT. It's about these large learning models, okay, and generative AI. And he describes in the first 51 pages, it takes about an hour to read, exactly what these things do, the small class of problems they solve. He talks about the you know, the randomness and stochasticity and hallucination, and importantly explains that, you know, those of us who develop these things, I mean, even we can't explain how they work. I mean, there is voodoo involved, but this is a good book. But kind of let's look at generative AI writ large, like right now, you know, in October 2024. I mean, it's you know, it's crazy. Now they say that you know, markets can remain irrational longer than a rational investor can remain solvent, and I think we're in one of those situations. Is this technology important? It's hugely important. Will it solve real problems? Yes. But I mean, come on. We have a company that's losing, what, $10 billion a year that just got financed at $150 billion valuation. $150 billion, if I'm not mistaken, that would be order of like Shell, you know, which is one of the largest companies in the world. That company, OpenAI, it could be gone next Monday. Okay, very high probability. I mean, nobody would be surprised if you read, and if you gave a report next Monday, you read the Wall Street Journal that OpenAI had folded its tent, and if it were gone, nobody would notice. I mean, the world wouldn't change a bit.
Let me add,
we have hundreds of companies being financed at multi-billion-dollar valuations by my friends on Sand Hill Road and whatnot, where people are. You know, we have 3 people out of Stanford or Illinois or Wisconsin or whatever it is who are, you know, starting, who don't know anything about law or medicine or dentistry, and are starting, you know, generative AI companies to use a language model to assist lawyers or dentists or, you know, divorce lawyers. I mean, hundreds at multi-billion-dollar valuations. We have people at these companies, leaders of these companies, I won't mention names, you know who they are, who actually think they're building God in a box. I mean, you can't make this stuff up. I mean, God in a box? I mean, really? So, you know, there's all this yap about, you know, sentient computing. You know, these AI models are going to, your smart refrigerator is going to take over your house. I mean, this is truly insane.
Tom, I love that you've come out firing today on this hype, and it's important because, you know, investors are seeing these stocks go up every single day, it seems like, because of AI hype. But let me lock in on ChatGPT or OpenAI. So you're the expert in this field. Are what they doing not unique?
Of the various language models that we're using, which is all of them, I mean, right now, ChatGPT has the hot ticket. I mean, they have the most useful language model that's out there. That being said, you know, we have Google, Facebook, Anthropic, Mistral. These people are spending billions on you know, on out innovating one another, and it's a you know, so there's no telling where this is going to end, and there's no reason to believe that one of these guys is going to win. I mean, this is just not that hard to do, and you know, we could have the next company coming out of the Bronx or Cambridge or Shanghai or Palo Alto that nobody's ever heard of that turns out to be the leader in the space. It's really exciting area, lots of innovation. Make no mistake, these things are useful and they will change our lives in important ways.
How do you see all of these very big companies that now are getting these very large valuations? And how do you see that? What's the end game? Like, what is their collective impact going to be on the internet, on the enterprise?
Well, this is, the market, when it sees, important innovations, it tends to overvalue them, be it transcontinental railroads in the 19th century or urban electrification in the beginning of the 20th century, which brought on the Great Depression, the dot-com era in, like roughly 2000. Now, was the internet overvalued in 2000? I mean, no way, no how. Whoever thought, whoever had the biggest numbers, 3 orders of magnitude larger than that now. But these market tends to, when there's something important happening, and this is important, it tends to, kind of irrationally overvalue these things. And then it resets by 10 or 15 or 25%, and we get on with the game. And, when that reset happens, we have a couple thousand companies go out of business, and that'll happen here. I'm not calling the top. These things can go, these things can go on for a while, and this might go on for a while. But it's pretty frothy. You get to generative AI, it's pretty frothy. Now, people are conflating, generative AI with the use of kind of meat and potatoes and social media AI with what C3 AI does, which is a little bit different. So we're involved in kind of meat and potatoes, run the business, supply chain optimization, production optimization in oil wells, smart grid analytics, contested logistics for the military, predictive maintenance for the Air Force. So what we're doing is a little different. We're about, companies making money, saving money, increasing productivity. So we're a little bit grounded. It's this kind of old school stuff. We're not doing God in a box.
Though we all know Nvidia, ChatGPT, and Tesla, it can be hard to imagine other real-world applications of AI technology. So for the close of our episode, we wanted to help you ground all of this in the real world. Coming at you back-to-back is the Citi Global Insights team with their newest research on, yes, humanoid robots, as well as the iconic Property Brothers talking about AI infiltrating your home. Enjoy. At some point, I may have to care for my aging parents. And it's something I've never done before, but maybe I just program this humanoid and let them take care of them. We're at the point where these robots could actually lift humans, and what does the AI look like here?
Well, the AI is a really important facet because, as I said, robots have been around for years, and we went from industrial robots to cobots, and things behind cages to things were whizzing around factory floors or warehouses, whatever else it might be. But in terms of making them useful for lots of different noisy environments, AI has now developed to a point where actually we can have a conversation using natural language processing previously, and now large language models and foundation models to be able to have a two-way conversation. You can take that and put it into coding to be able to codify the actions that you want them to be able to do. They obviously are able to see, and I think it's pretty remarkable, just as an example, and you take a step back. We wrote our first Car of the Future report in 2014, thinking about autonomous driverless vehicles. And yes, it's a long time coming for different reasons like safety and regulation, etc. But the reality is you can now have moving robots going at 70 miles an hour around the streets in certain places. So it's not too much of a leap to think, well, if you can move from there to be able to move to, less noisy, easier to navigate environments, that they can be very useful. But this AI component is really critical. And one of the things people talk about in AI is now we have the ability to have multimodal AI. So rather than just discrete units of this is great at vision, this is great at language, etc., this is great at coding actions, you're able to then bring them all together. And that's what turns them from, quite frankly, being potentially more useless to being more useful.
Wenyan, your $7 trillion market potential note by 2050, what are some of the challenges to reaching that? I imagine manufacturing robots on this scale might be one of them.
Yeah, exactly. I think one of the challenges is that we don't have the scale of production right now. A lot of those parts for those humanoids, for those humanoid producers, they're just 3D printing all of the parts. I think one of the hindrance would be we need to build the production line for that, and also the the way that I like to think about this is that AI is the brain of humanoids, and then we need to train the AI in the real world in order for them to learn how to perform specific tasks. And in order to train them, we want to have the data for them, but we are running out of data. Data is really important. I think a lot of so one of the infrastructure that you can invest in is data centers, because it really powers the training of AI. So data would be one of the barriers, and now is currently roughly 20% of human efficiency, and it still continue to learn. It developed really fast, but we need some time in order to get to a world where the efficiency of humanoid is like 100% or 200% of human to reach that substitution ratio of 1:1 to 2:1.
You mentioned, Wenyan, in the report that one of the biggest opportunities for humanoids is well, I'll list them here. It's home services, industrials are key, delivery. Why home services? Like what do you think a humanoid will end up doing?
I think the biggest area for is really home services, is because we've got a huge number, 3 billion households in the world, and based on the survey that we saw, 70% of the homes in the world they're potentially willing to adopt. But obviously there are differences by development in different areas. So we segment the geography into more developed areas, less developed areas, and least developed areas. And we apply a very conservative number for the, even though we apply a very conservative number, we still get a very huge unit number. So what they can do is they can do a lot of things. You've already got the robot cleaner in your home mopping your floor, and they can do the laundries, they can make you a cup of tea, they can mowing the lawns, and they can take care of the elderly people that you don't need to send your grandparents or parents to the care home. You can just take care of them at home. I think this is one of the biggest use cases, actually.
That's just I just program my robot. They can take care of my mom or dad. They can just serve them food. They can call them. Maybe because I don't have to call them. Maybe you can't even do that.
There's so much tech that you can control from your phone that keeps every aspect of your home safe, whether you're home or not.
On the cool side, I just saw technology, and I know they've been working on it for a while, but it's first going to hit like the media space, and then it'll come into the residential space when it's affordable that way. But it's 3D color. It's 3D television basically without the glasses. So you're basically watching a TV and it's full 3D coming right at you, and they call it solid light. It's pretty cool. So technologies like this, imagine having a fireplace. It's an electric fireplace, so there's no hazard, there's no CO2, no issues that way, but it literally looks like a real fire in your space and you still get the heat.
You know what I'm interested to see, because I've seen a little bit of this, but it's not quite there yet for the average consumer. But because a lot of people are trying to live in a smaller space that's more multifunctioning. It can be multiple rooms, or you see like in Japan they have like a one room that the toilet comes out of the wall, and the bathroom, the kitchen, everything's in one room.
The toilet comes out of the wall?
Oh yeah, like it's a panelized system. So if you look up online, you'll see
you got a real focus on toilets over there.
I'm taking it all in, guys.
Toilet notes.
I only get like a finite amount of time with like guests, especially you guys.
But this is the thing. I don't like the idea that you have this tiny room where your kitchen sink and your toilet are right there together. However, what I'm looking forward to seeing is how they have larger rooms that do adapt the room. If you want to entertain guests, it manipulates the walls or moves the walls so you have better space for a dining space, and then it can shrink down and give you a second bedroom or whatever you need.
You know what's wild is you do actually see a lot of incredible innovation come out of Europe or come out of Asia when it comes to tiny spaces, because they're dealing with a different type of housing over there. Well, you mix that now with the AI technologies that are coming along. Drew talked about leak detection earlier, which I think is incredible, because you can have AI-driven leak detection so that if something's happening, there's a flood at home, you're not responding, it'll automatically turn off your water. But again, talking about seniors and aging in place, you can also adapt that technology so it says, hey, somebody who's living in this home hasn't used any water all day, you might want to check on them. There could be a problem. So I love the fact that we're seeing now all this great innovation, all this great technology merging into what will be a much smarter home.
And price coming down on that too.
This is your latest episode of Opening Bid. Once again, be sure to hit us with those likes, follows, and subscribe wherever you get your vodcasts. Happy holidays, everyone.